Welcome, everybody. We're going to spend the next 2.5 hours, so get a strong cup of coffee, talking about what to advise clients now in the wake of the Georgia runoff election. We had presented a prior 1-hour program almost immediately after the election results were known in early January. And now that we've all had a little more time to reflect on it and the Biden administration is moving along, we're going to take a much more in-depth look for 2.5 hours instead of 1 hour. I'm planning to recommend to clients now. Thank you for joining us, and I'd like to thank our sponsors, Peak Trust, Interactive Legal, we'll mention them again in a moment, and most especially my co-speakers, Jonathan Blattmacher and Robert Keebler. For Interactive Legal, one of our sponsors on slide 5, Interactive Legal is a document generation software program that I use personally in my practice, and I'm not a paid speaker. Interactive Legal provides a mechanism, a methodology to draft and create literally, I think, every one of the trusts and mechanisms that we're going to talk about. And there's a number of points in the presentation where we'll present, courtesy of Interactive Legal, some of the sample language for those of you who may not have access or not subscribe to Interactive Legal, so you can see some of the drafting language that they recommend. Our second co-sponsor is Peak Trust, and Jonathan, you were going to say a word or two about Peak.
Yeah, Peak Trust Company, formerly the Alaska Trust Company, is a full-service trust company located in both Alaska and in Nevada, although it services clients in all American jurisdictions. I have sent literally hundreds of clients there. I don't own an interest in Peak at all, but I've sent hundreds of clients there. Everyone has been extremely happy with the service they've gotten from Peak. And in fact, virtually all of my family's trusts, and I have many, even though I'm not that wealthy, are at Peak, and I'm very pleased with the attention that I get.
And finally, it's been our custom to mention a charity in each of the webinars we've done. And today I just will make a quick mention of the American Brain Foundation. Their mission is to cure brain disease. The idea is that an integrated holistic approach of looking at the brain in its entirety and all the different brain diseases and funding research that's calculated to best help the overall effort will lead to greater identification of cures and treatments. The American Brain Foundation is quite unique in this area in that they have a close working relationship, partnership really, with the American Academy of Neurology. So through that connection, they have access to the leading neurologists in the country to help direct and select research projects for them. With that, we're going to jump into the program. So let's begin our discussion. We all know now that President Biden has been elected. The House is Democratic, the Senate is split, and the tie-breaking vote will be cast by Vice President Harris, which in fact recently just occurred on another piece of the legislation. Jonathan, you want to set the stage for where we are in terms of the political situation and why it's such a critical time for planners?
Thank you, Marty. As probably everyone on the phone knows, the Senate has adopted a rule, and it's been there for over 100 years, that you cannot filibuster a bill if you get 60 senators to say they want that filibuster broken. The filibuster is when, as a matter of courtesy, a senator is given the floor, and that senator can talk for as long as he or she wants. And that means that they can basically tie up for days and weeks, and it's actually gone on in some cases for weeks. I mean, senators have gotten telephone books from all around the country and just read names, and it means that the legislation which is up isn't going to pass. But the Senate has made some exceptions. One is for the election of federal judges, and another one, extremely important, is for a budget reconciliation bill. And the budget reconciliation bill almost always has tax changes. And the first time I remember it very clearly was in 2001 when George W. Bush wanted tax changes. and yet they had a tie in the Senate, but Dick Cheney could cast the deciding vote. And that is important. But there's one other important measure, and I actually called Tom Daschle, the head of the Democrats in the Senate, and I spoke to him. I was surprised he came to the phone, but he did right away. And I said, Senator, you can't stop George W. Bush from getting through the Tax Reform Act of 2001, which made dividends taxable as long-term capital gain, which reduced rates, especially on wealthy people, and there were another number of other goodies for wealthy taxpayers. But I said, you can limit its duration. And he said, what are you talking about? And I said, if any senator objects because the bill will either reduce revenue or increase expenditures, then they can only have it go into effect for 10 years unless 60 senators vote otherwise. So Senator Daschle made that objection. So when the Tax Reform Act of 2001 passed, he objected, and sure enough, it turned out that it could only last for 10 years. And indeed, that's why we all thought at the end of 2012, the exemption, which under the 2001 Tax Act was being increased essentially from $1 million to $5 million, we knew it was going to be reduced back to $1 million because it had to sunset. Now, as it turned out, in fact, Mitch McConnell, then the head of the Senate, John Boehner, then the head of the House, and Barack Obama sat around at the end of 2012, and I envision they were just like a bunch of little boys trading baseball cards. Well, I'll give you a Willie Mays if you give me a Roger Maris, or whatever the deal was made. By the way, no other Congress people or senators were allowed into that room where they negotiated. And apparently Mitch McConnell was so anxious to keep that $5 million exemption that indeed it stayed. Now, that also happened with respect to the 2017 Job Acts, Tax Cuts and Jobs Act that came into effect with President, what's his name? Oh yes, Trump, yes, President Trump, how could I forget? But in any event, that went into effect, but you know that the exemption, which is now up to $10 million, adjusted for inflation, so it's now $11.7 million, is going to disappear at the end of 2025. Why? Because it reduced the amount of revenues the government would receive. And as a consequence, one of the senators in the Senate objected, and that means it has to go away. So that's important to think about. But now with the Democrats basically in control of the Senate, and because there is an exception from the filibuster rule for a tax reconciliation act, it means that the Democrats can get through what they want with respect to taxes. Now, those taxes will actually increase, which means they could be permanent unless you again get a Republican Senate, in which case it could be changed. But some of those changes will go through, and it will only take Vice President Harris voting the tie casting vote. Now, there will be a lot of give and take in this. Don't just think it's all going to happen. We're going to discuss some of the things that might happen. But one of the things is you will have deals made even among the Democrats. We're going to talk about some proposals that Bernie Sanders has made. There are proposals made by others, and some of those will be traded off, not just with Republicans if they want to get into the act, but also among the Democrats themselves. Back to you, Marty.
So we're really at a point in time where last year there was incredible concern that if the Democrats swept, there could be massive income and estate tax increases. And then we planned considerably for many clients to get planning done by year end out of the fear, and we're going to talk about it in a moment, that there'd be retroactive tax changes this year. And we're going to discuss what to do about that and what we each feel about it. But now that we had the unknown of the Georgia election and that was resolved, the sweep that was talked about or feared from a tax increase perspective never happened. But nonetheless, subject to some of the caveats Jonathan just explained, the Democrats have control. And I think it's fair to say that Bob, Jonathan, and I and certainly likely most of you anticipate some significant tax changes at some point. That point we can't tell, and we'll talk about that. So I think the situation is such that right now we need to advise clients to plan in anticipation of potential tax changes. We can't predict exactly what will happen. Nobody can, but it seems mistaken, certainly in my view, not to plan now for those that didn't plan last year. And for those that did planning last year, this may be one last bite at the apple if there is no retroactivity. Values of some assets are at all-time highs, stock markets at all-time highs. Values of other assets remain depressed because of COVID. Interest rates remain at historic lows. The bailout bills that President Biden is proposing, the current $1.9 trillion bill and bailout bill, and perhaps others to follow, even if it's not enacted at that level, are massive, and that too may suggest or encourage tax increases. Slide 13, we're going to talk about the goals of 2021 planning. And one of the goals, which Bob Keebler is going to address in a few minutes, is income tax considerations, because we could face some very significant income tax increases, and we'll come to that. From an estate planning perspective, the goals are similar to last year other than the first bullet point on slide 13. So the most important point, or one of the most important points, just as if with 2020 for all but the ultra high net worth client, and even that's not a misnomer, because I think many people define 30 million and above as ultra high net worth, but even at a $30 million wealth level, you can't transfer even one exemption without carefully thinking through what degree of access. And if it's a married couple with a $30 million net worth, you really can't transfer 11.7 times 2. Maybe that's too much altogether, but if it is feasible, without great consideration to access. So given the large size of the current exemption, perhaps for clients worth 40 or 50 million and under, we all have to give great thought, just as we did last year, to preserving access to assets. So the challenge will be, how much access can I give a client to assets they're trying to move out of their estate, use the temporary exemption before there may be a change, but nonetheless preserve access to that asset without undermining the estate tax goal of moving it out of the estate, and without undermining an asset protection goal of protecting the assets moved into, for example, irrevocable trust from creditor claims. Using exemption remains, for those that still have significant exemption, perhaps the most important goal from an estate tax planning perspective, especially if access can be preserved. But keep in mind, and I've seen a number of emails from colleagues, younger colleagues, indicating a misunderstanding of this. It's not only about exemption. So for example, one of the Democrat proposals, and I think this was in the Obama Green Book and the Bernie Sanders tax bill for the other 99.8% he proposed last year in the Senate, and Congressman Gomez proposed a similar or identical bill in the House, was that every 50 or 90 years to subject assets in a dynastic trust to GST tax, and also to cause the inclusion in the donor settlor's estate of assets in a grantor trust. So when we talk about planning objectives, certainly using exemption is critical, but it is not the only goal. So if we can get trust done now before a law change is announced, and if it's not retroactive, then the trust that we create today may be grandfathered for GST and grantor trust inclusion purposes. They may not, we don't know, but it certainly seems well worthwhile to try to create a irrevocable trust to make GST allocation and create grantor trusts so that they might be grandfathered. So again, exemption, just like last year, use of exemption remains vital, but that's not the only thing. And similarly, a lot of the planning tools and techniques that we have, discounts, right? The 2704 regs or something akin to that may come back. Discounts could be restricted or eliminated. So clients with very significant net worth and family businesses, for example, may want to sell or transfer those business interests to trust, even if they've used exemption, to lock in the discounts, because those may disappear. Asset protection planning remains critical. Some of the proposals have talked about $1 million gift exemption. If we have $1 million gift exemption, that could put a chilling effect on a number of asset protection planning techniques. So even for more moderate wealth clients, we're using the exemption as not the primary goal. Asset protection may be. So if a client's worth $5 million and is a physician, getting assets into an irrevocable trust that they can access, whether it's some type of SLAT, hybrid, DAP, DAPT, SPAT, and we'll talk about all those in detail, from an asset protection perspective while preserving access may be far more important for that client than just the use of exemption. Now, wealth tax. We have no way of predicting, and I'll ask Bob or Jonathan if they have any thoughts, but it should not be dismissed that the Democrats may be bringing back some efforts to enact some type of wealth tax along the lines of things that, for example, were proposed during the primaries. Elizabeth Warren had suggested it. Others had suggested it. Do either of you have any thoughts on the possibility of a wealth tax and whether shifting assets to dynastic trusts now may avoid it?
Well, Marty, I don't know that moving it to a dynastic trust is going to make any difference, because I assume that if you do have a wealth tax, it'll apply regardless of who is the taxpayer. And remember, with a grantor trust, it's going to go back to the grantor. There have been serious proposals on that, and everybody on this call, directly or indirectly, every year pays a wealth tax. And that wealth tax is because you own real estate or you rent. And real estate in every area of the United States is subject to an annual wealth tax. It's called the real estate tax. You don't have to sell it, you just hold it, you do nothing with it, but each year there's a tax imposed upon that wealth. And that's the way it might work. However, there probably is a constitutional limitation. That limitation is contained right in the Constitution, which prohibits the federal government from imposing a direct tax on property. And although I've never looked at it, I've long assumed that the reason for that is that the states and their political subdivisions relied primarily on real estate taxes to fund their governments. And they didn't want the federal government horning in on that. In fact, it was a great hue and cry in 1916 when the federal government adopted an estate tax. And the states really pushed back, saying this was our area of taxation, you can't come in and do it. But they did it because they needed money to enter World War I, which certainly happened. In the 1920s, there was a proposal to repeal the federal estate tax. And instead, the federal government said, look, here's what we'll do. We'll give you basically 80% back in the form of a state death tax credit for the federal estate tax we pay. And that was contained in Section 2011 of the Internal Revenue Code. It's since, of course, been repealed under the 2001 Tax Reform Act. But the states don't like the federal government horning in. Now, so constitutionally, could they do it? Well, some think yes, some think no. The one thing that has been proposed, and this has been proposed by Senator Ron Wyden, who is the head of the Senate Finance Committee, which is the tax committee in the Senate. And he has proposed an annual tax on the increase in the value of assets. So if you hold a bucket of marketable security, say as Bob Keebler does, worth 100 million, and if it increases to 110 million next year, Bob would have to pay basically an income tax on that $10 million growth. It's a mark-to-market income tax. And you might think, oh my gosh, that's got to be unconstitutional. Well, we've had mark-to-market taxation with respect to certain financial matters for over 30 years. There have been attacks. There has been none that's been successful, although it has not yet gone directly to the Supreme Court of the United States. But that certainly could happen. It's something you need to concern yourself. But because we don't know, one, what form it would take, or two, whether or not it's going to be enacted, we don't know what we can do. Perhaps similar is if, and we'll talk about more about this later, what about a capital gains tax at death? Can we head that off by doing some transfers during lifetime? But Marty, I'll put that off until we get to that topic later.
Yeah, we'll come to that. Slide 14 is just a comment. The planning that we're all struggling with now is incredibly complex because of the uncertainty alone. And I think that's pretty apparent. We don't know what's going to happen, although I think it's fair to say we all feel something is coming around the bend. The issues that we deal with in transferring the magnitude of wealth we're talking about, a married couple twice the $11.7 million exemption, is a very substantial sum of money for a very large proportion of clients. I mean, earlier I stated you probably are going to be looking at clients worth 40 to 50 million and up before you stop worrying about, and even at that level, we all have many clients that still are concerned because their burn rate, their spending level is so high in terms of making sure they have sufficient access. So the comment on slide 14, and we're going to address this in a different context in a few minutes in terms of protecting ourselves as practitioners, but the right way, the better way, the smarter way to plan is to do it collaboratively. If you can have financial models and forecasts done to show a client what things look like if they make gifts, it makes it much safer, much greater likelihood that the client won't run out of money because they see what the numbers are and they know what they're getting into, and they may recalibrate how much they're willing to transfer. Life insurance can be an incredibly helpful tool to address the mortality risk in non-reciprocal slats, to address the mortality risk as you lengthen the term of grats, which we'll talk about. Having a review of property, casualty, liability, life, disability, and long-term care coverage before clients transfer an $11.7 million amount to an irrevocable trust, even if they have some means of access, can be vital to protect the client. And I think all of these steps can be vital to protect us as practitioners, because by getting other practitioners involved in different fields, we're making sure the client sees the planning from different lenses. If other advisors identify issues or concerns, it helps the client understand the transaction. It helps protect us in terms of making sure the client was aware of some of the risks and the financial implications. So don't forget all of that. And I think everyone knows that.
Marty, it's Bob. Could you just back up to slide 14, please?
Sure.
On the insurance, I have two comments. One is, if we go back to $1 million gift tax exemption, there'll be a great deal of stress on transferring property out of your state to buy insurance. So I would think within 24 or 36 months, all of us will have a very strong expertise in split dollar. We've been able to ignore the complexity of split dollar really since 2010 because we've been able to fund it using a very large gift tax exemption. So you have to think about this like a very complex board game. If we only have $1 million gift tax exemption, we're going to have to preserve that. It's very precious, and we'll definitely be looking at split dollar. Now, the other thing, switch gears. We represent a lot of people with very large IRAs. And for the last 10 years, I think our go-to has been Roth conversions. And the Roth conversion, when racing against a regular IRA, almost always wins. We know that. But that was because we had a combined deduction for exemption for a married couple of 10 million, and then for the last 3 years, it's been 20 million plus. If we go down to 3.5 million, Marty, think about this. Husband and wife can only have 7 million of property. Those Roth IRAs that grow and grow and grow are going to run into that $7 million exemption. And I think what we're going to see, again, just like the split dollar, I think 2 or 3 years from now, every one of us will be very learned in how to do what we call IRA relocation, where instead of doing Roth conversions, we take money out of the IRA and we jettison that money into a life insurance trust where, when we die, it will not become subject to the estate tax. So those are just, this is the type of thing we have to think about, is really not just the planning techniques per se, but big picture. When we run into $1 million gift tax exemption, it's going to change the way we do insurance. And if we have a $3.5 million estate tax exemption, we're not going to be able to do as many Roth conversions. We'll probably be doing a slightly higher percentage of IRA relocations to trusts. Back to you, Marty.
And one of the ways to address that and sort of lay the foundation for what Bob talked about, and I think he's spot on, life insurance, if a lot of the changes that we're talking about go through, life insurance will be a much hotter ticket for planning than it's been in a while. And one of the things you can do is when you create the irrevocable trust that we're going to be talking about, for example, slats, non-reciprocal slats, you probably can build in insurance provisions. If the client has a directed trust because they want to be the investment director. You may want to build in a separate insurance director so that the client's precluded from having any 2042 incidents of ownership over the insurance, but yet the same trust can own insurance. Think about how powerful these slats are if you're gifting the 11.7 million exemption or as much as the client can. If you layer into that when you plan it today, a separate insurance trustee and provisions to own and hold life insurance. One of the big problems with insurance, as Bob pointed out, in the past was getting the dollars into the trust. With the big exemption for a significant majority of even wealthy clients, the large exemptions resolve that. We may be back to that environment. Why not plan now? And I think Bob's just made a great case for planning now. If you can shift millions of dollars of a client's wealth into, for example, and we'll talk about other options and details in later, non-reciprocal slats that have an insurance overlay, you really have an incredibly dynamic ILIT with lots of funding to help you with future planning. Why not create that today? So section 15, I'm not going to belabor because Bob has a lot of really great slides on income tax planning, but I just want to point out a few things. With the dollars that are being shifted and the complexity of planning and the uncertainty that Jonathan highlighted, we face a lot of potential liability and responsibility as planners. And I think we need to be careful. And this is just a reminder warning. I always know, for example, when I hear Skip Fox speak at Heckerling and other places, you know, he often raises issues that highlight how it's so important to focus. And Howard Zaritsky does that a lot too. And I often get nervous listening to them, but that's a good thing. So I just want to make a few points in that vein to keep us all alert to some of the risk and issues that we face and what to do. So first point on slide 16, last year in 2020, there was a lot of talk about building in disclaimers. We're going to do that again in a few minutes, but in the context of retroactivity, there's a lot of talk last year about promise gifts. For many clients, those techniques made sense and they were being discussed for specific reasons. But for some number of clients, those things are being discussed because frankly, the client just did not feel comfortable committing to making transfers. So the concern that we need to be aware of is these are big dollar transfers. We don't want to be in a position of a client saying, well, hey, that estate planner told me to do that. They pushed me to do it. If a client is hesitant, just say, listen, if you're not comfortable, don't make the transfer. We can show you lots of ways to get access to the assets you transfer out of your estate. But if you're not comfortable as a client making the transfer, even with the things that we tell you, don't do it. You're never going to have the same level of control after a transfer as before. Be wary of the client that's uncomfortable. And that's also why I really like involving a collaborative team. If the client is uncomfortable and the financial advisor, wealth advisor shows them some Monte Carlo simulations and demonstrates that they have no worries about finances, even if they can't access the money in the trust, maybe the client will be comfortable. But whatever result, if the client's financial advisor has shown them simulations and forecasts of what the numbers look like, it really helps cement it visually for the client so they can't say they didn't make an informed decision. It helps protect all of us. Slide 18 are just a few points of things that you may want to consider. They're clearly not a standard of practice, but just a few points, and let me just state some of them. We try to use a solvency affidavit for any large transfer. Now, some states, and I think Alaska's one, require a solvency affidavit if you're setting up and funding a domestic asset protection trust, a self-settled trust. But why only use it if state law requires it? It's a fairly simple document. The client is stating under penalties of perjury that they're not aware of any other claims, that they have enough assets to meet their ongoing expenses, that they're not delinquent on alimony or child support, and so on and so forth. First of all, if the client is later attacked that the transfer that we're planning with them was a fraudulent conveyance, having had an affidavit signed, I think can only help. So I think it's something that we should do. I think it's also protective of the practitioner. If the client signs an affidavit that they weren't aware of any claims, it certainly confirms that we didn't know there were any claims. Have the client prepare and sign a balance sheet, lien judgment and other credit reports. Do some due diligence. Build a due diligence file with a solvency affidavit, a balance sheet, some searches before the significant transfer. Now, in 2020, planning was so compressed, many of us just couldn't get to this kind of stuff. It's still fairly soon after. Maybe this stuff gets done now. Forecasts and modeling. Offer the client options. I think that's one of the most protective things that we can do. You can't give every client every single option of every single possible planning technique, but I think it's important to suggest and document that you've told the client 2, 3, 4 options to planning. So it's the client's responsibility to select which of those options that they're going to pursue. Then if the client is later unhappy or the option doesn't work, well, you didn't only make recommendations, you made several recommendations, not just one. And the client made the choice. I think it's vitally important to protect each of us, to apprise the client that every planning technique has risks. There's nothing for certain. I think Jonathan and Bob's comments about what might come down the pike in terms of legislation demonstrates uncertainty. But, you know, even a simple life insurance trust, you know, there's a wealth of issues on grantor trust status, on crummy powers, you know, for doing non-reciprocal slats. You know, can we be positive that we've avoided the reciprocal trust doctrine? Probably on 2021 planning, you can't differentiate, just like it was tough for most of 2020 planning, based on having different plans and the trusts set up and funded at different times, because there's probably not enough time. And I think the client will have to make a decision. Do we want to have months of time pass between one slat and another, hoping that's enough? Or do we just want to get them both done, hoping to beat the effective date of any new legislation? So one of the things you might do is in your engagement letter, just advise the client there's risk associated with every plan and every technique. And by proceeding, the client has to accept the risk that we propose. So bottom line, we're still talking about very large wealth transfers with an incredibly uncertain environment. All we can do as advisors is the best we can do. Now, the next topic, and I'm going to turn this over to Jonathan, and I think Bob will also comment as well, is we have a concern, not we, Jonathan, Bob, and I, but we as a profession, about the potential for a retroactive tax change. And I think the later in the year we get, I think the less concerned that will be. I think given the incredible issues of COVID and the economy that the Biden administration is grappling with, I just don't know when we'll see tax change. Some well-respected, knowledgeable colleagues of ours on other programs have suggested that they don't think there's going to be any tax legislation effective before January 1, 2022, meaning next year, which means we have a full year to plan if that's true, but we don't know. So Jonathan, do you want to talk about retroactivity and why it's a concern, and then we'll get into what to do about it?
Thank you, Marty. As shown by the two cases on your screen, the Supreme Court has ruled that the Congress can make changes retroactive, even if the only reason is to raise revenue. So you can't be certain. And there have been many circumstances in the past where at least some changes have been made retroactive. For example, a tax rate change, you might say, well, why don't they make it effective on July 1? Well, that depends on when you're going to include something in income. Also, you have questions about when you take deductions. So it often is, if they want money or for some other reason they want to get something into effect right away, they'll make it retroactive, perhaps to the beginning of the year. One area that might happen is with respect to the state and local tax, the so-called SALT deduction, because the head of the House, Nancy Pelosi, who's from California, and Chuck Schumer, the head of the Senate, who's from New York, desperately want that to go back into effect. So it's possible that that would be made retroactive to the beginning of the year. On the other hand, as Marty says, as you get later in the year, it becomes much more difficult as a cosmetic matter to make adverse changes retroactive. And as I said, restoring the SALT deduction would be a beneficial one. So making it retroactive to the beginning of the year, there'd be very few who would complain about that, except that it will increase the deficit. So you have to watch out for that. When Donald Trump got through the 2017 Tax Cuts and Jobs Act of that year, all the changes were made prospective only. They went into effect on January 1, 2018. But we can't be certain, and it may be possible that they would make the changes retroactive either to the date of enactment, which again has happened in some cases in the past, or to the beginning of the year. Now, you might say, well, that's not really fair. If I've made a transfer using my gift tax exemption, it's just not fair to make it retroactive to the beginning of the year. Well, fairness in the tax law doesn't really matter. But what they could do is to certainly say, well, we're going to make it retroactive for estate tax purposes. We're going to have a $3.5 million exemption. No one can say, I planned my death while the exemption was 11.7 million, so I ought to be able to use it because I died before the effective date of the change. So it's not certain, as Marty said, whether or not these changes will go through, and it's even less certain whether they will be made retroactive, but it's certainly a possibility. So one of the things is to talk to your clients about that and see whether or not we can come up with a way that if we want to undo what has been done, we can do it in a way that won't be harmful to anyone. Marty?
Jonathan, I'm having a connection issue. Just talk for another minute and I'm going to try to fix it.
Okay, yeah, let me mention that we're going to talk about ways in which you can undo a transfer for estate and gift tax purposes. But here's one. Consider putting in a disclaimer. So if you're going to give your child 11.7 million or 5 million or whatever, the child can disclaim it, and presumably it would go back to you. Now, first of all, making an outright transfer to someone violates my #1 rule. You never make transfers outright. You always make them in trust, whether it's for your spouse, whether it's for your niece, your nephew, your brother and sister, your kid, whatever you're going to do, you want to do it in trust. Well, how do you do a disclaimer when it's going into trust? Well, the way it's done, and this is covered very, very clearly in the regulations under Section 2518, the federal disclaimer statute, is you can provide for disclaimers in the trust, and you can do it at least in one of two ways. First, any beneficiary can disclaim the interest offered to him or her in the trust. So if I create a trust, say, for my son, John, and in the trust, I say that when John dies, it's going to go, say, to his descendants per stirpes. He has a right to disclaim. He has that right under New York law and under the law of every other state. And if he doesn't accept benefits, and he does it in writing, and it's delivered to me, the transferor, within 9 months of when I made the transfer to the trust, he will be deemed to have made a qualified disclaimer, which means two things. Number one, it will be treated as though I never made the transfer. And number two, he won't be treated as making a gift by doing the disclaimer. And what you can do is not just provide that a beneficiary can disclaim on himself or herself, but you can provide for a beneficiary, whom we label as the principal beneficiary, to be able to disclaim on behalf of the entire trust. So I could put in that if my son John can disclaim on behalf of the entire trust because he's the principal beneficiary. So rather than having it then go to his kids because he's disclaimed and perhaps under state law treated as though he died before the transfer was made, but in fact be treated as coming back to me. And in fact, it's probably theoretically possible that you could have a trustee actually make the disclaimer. There is some law to that. One of the cases I was involved in was the estate of Edward Hoenig, H-O-E-N-I-G. That's a 1976 tax court case. Mr. Hoenig was a very senior gentleman, and he had married a significantly younger woman. It was a first marriage for each of them, and they had some daughters, fine family. And because he was 30 years older than his wife, he knew he was going to die first. But lo and behold, she fooled him, and she died first and left her estate to him. And that meant that his estate would include not just his property, but the property that was bequeathed to him by his wife. So that would have pushed them up into much higher brackets for both New York, where he lived, and for federal purposes. So we proposed a disclaimer. I took the disclaimer over to Mr. Hoenig's home one afternoon in Brooklyn. The housekeeper came out and she said, "I'm sorry, but Mr. Hoenig doesn't feel well. Come back tomorrow." Well, I came back the next day and she said, "Mr. Hoenig died last night." So we couldn't have him do the disclaimer. So we decided, could we have his executor do the disclaimer? Fortunately, a case had been decided in the New York County Surrogates Court, and it held that an executor could disclaim on behalf of the decedent if the decedent had not, in fact, accepted the property. Now, this was before Section 2518 was in the code. The IRS said, no, Mr. Honig's executor could not disclaim it, so the assets that his wife owned were going to be added in his estate, and as a consequence, we're going to impose additional estate tax. Well, the tax court in that 1976 case, remember 2518, the federal statute didn't become effective until January 1 of 1977. The tax court said, no, we find that disclaimer by Mr. Honig's executor was in fact valid, and that worked. And you could do the same thing for a trustee. However, you get into questions like, can a trustee really disclaim, or would the trustee be violating the trustee's fiduciary duty? Maybe you want to go to court. In fact, I think in Texas, for a trustee to disclaim, you have to go to court and get the court's permission. Other states, like in Alaska, the trustee can do it as long as the instrument by which the transfer is made authorizes the trustee to make the disclaimer. Other states, such as New York, we have no rule for trustees. We have a rule for executors, but for some reason, and maybe I can take the adverse responsibility here because I was involved in the drafting of the New York disclaimer statute, EPTL 2-1.11, that I didn't think about it even though we had the Honig case. So I think it's going to be much safer if you want to use this route to put in that the spouse, the eldest child, whoever it is the principal beneficiary. It doesn't mean they have to get everything, but say they are the primary beneficiary and they can disclaim anything offered to the trust itself. And that way you can do effective disclaimer within 9 months. One of the things, and that means if you did the disclaimer, for example, now you created trust now, say we're up to say March 1st, you'd have 9 months would take you almost to the end of the year. But some people say, I want more time because maybe Congress will do something in December, and I can't be certain as what's going to happen. So what do I do? Well, maybe you ought to put in, your 18-year-old granddaughter to be the principal beneficiary, because under 2518, she has until 9 months after her 21st birthday. So you would have a lot of additional time. But the disclaimer really gives you a lot of flexibility to undo it. Now, you can't have the person designated that primary beneficiary with the power to disclaim on behalf of the trust. You can't have them agree ahead of time. You've got to count on them. So when you talk to your client about putting in a disclaimer, maybe if they're married, their spouse should be the one, maybe, their eldest child or the one that they think is most sensible would be the one who would do the disclaimer if the client says, I want it undone, either because of a retroactive change in the law or just because fortunes change and the client wants it all back. But we're also going to talk about some ways in which the client can actually keep her hand in the assets without causing estate tax inclusion problems. Marty, back
Jonathan,
to you.
Yeah, let me ask you a question about the disclaimer approach. How do you feel, are you concerned about a trustee being able to disclaim, assuming the instrument in state law permit it, in terms of violating fiduciary duty?
Well, I briefly mentioned that, Marty, and I think it's a question, but I think if I create a trust, and let's say I name Bob Keebler as the trustee, and I say that Bob is permitted to disclaim on behalf of the trust, and he can do it for any reason or no reason at all, and he will have no liability to any beneficiary for making the disclaimer or not making the disclaimer. And you've got to cover both making the disclaimer and not making the disclaimer, because maybe it'll turn out that it wasn't such a wise thing to make the disclaimer for whatever reason there may be. So the trustee could perhaps be criticized, perhaps even sued for that. But I think if you expressly authorize a fiduciary to do something, even though it might seem that it's not in the beneficiary's best interest, but again, if you say that the trustee can take into account other factors such as what the transferor, what I, the grantor, intend with respect to other dispositions of my wealth, then I think it might make sense, especially if it's got something to do with a retroactive change in the law. Can't be certain.
Do you have any concern that if you put in a disclaimer that the IRS may argue that the transfer is incomplete because until the 9 months was up, somehow you had an implied agreement while you debated whether to make the transfer real? Do you have any concern that that could pose a problem? And I guess in the context of 2021, where that would be an issue, is if there is an effective date of the new law, say June 1, and the disclaimer doesn't end till, you know, October, November. Do you see any issue in terms of undermining the planning with the disclaimer?
Well, Marty, as I said before, I think you have to be sure that you can establish that you did not discuss with a person who's authorized to disclaim or with a trustee that you would expect them to disclaim. You always have this, no matter what transfer you make, whether it's during lifetime or at death, you always have the possibility of the disclaimer to undo it. So for example, if when I die, I provide for my assets to go to my wife, and she has the power to disclaim, whether it's explicit in the instrument or it's just pursuant to state law, I know the IRS cannot argue as a practical matter that it really didn't go to my wife because she could have disclaimed, or if she dies, her executor could disclaim, and therefore it didn't qualify for the marital deduction. Again, I think if you try to be too cute and talk to the person whom you've authorized to disclaim, whether that's the trustee or a primary beneficiary, then I think it gets a little bit more dicey. So, but I think, you know, disclaimers are well known. The regulations under Section 2518 give lots of examples of disclaiming both outright transfers and transfers in trust. And again, if you make a qualified disclaimer, which means that you cannot have accepted benefits, among other things, it means that the transfer is never deemed to have been made for estate and gift tax purposes to the disclaimant, and the disclaimant is not deemed to have made a transfer for estate and gift tax purposes by reason of making a qualified disclaimer.
So it sounds like there's really no downside to doing a disclaimer. So if we have an uncertainty, because I think a lot of people don't feel there's really a meaningful risk of retroactivity, but the cure, if you build in a disclaimer and given some of the suggestions, caveats that you've given, there doesn't seem to be a downside. So can you, let me ask the question another way, and then I'll introduce and segue to the next way of unwinding transactions for retroactivity. Why would a practitioner not include in any new trust they're drafting right now in 2021, why would you not include, would there ever be a reason not to include a disclaimer provision just in case there's retroactivity? Why not just throw this into every trust we do this year until we know what the law is going to be?
Well, Marty, I've been putting this in my instruments for a long time, and wealth transfer planning, which you mentioned earlier, has provisions where you can add it in. The only reason I would not do it is because you think you may have a recalcitrant disclaimant where the person shouldn't disclaim, but they do. But that's the only downside. If they always have a right under state law to disclaim. It's just that you can provide how it goes. Now, this is critically important to understand. Typically, when you look at a disclaimer, you treat it as though the disclaimant has predeceased the transfer. So again, if I say this goes in trust for my wife, and when she dies, it's going to go to my descendants per stirpes, the normal thing is if my wife disclaims, it would then be treated as though she had not survived, and it would go to my descendants per stirpes. But you don't have to provide for it that way. You can provide for an alternative. For example, I might provide that even though the trust says when my wife dies, it'll go to my descendants per stirpes, I can provide that if she makes a qualified disclaimer, a quarter of it goes to my brother Douglas, or to my nephew Matthew, or to my friend Marty, or my friend Bob. It's very, very clear if you take a look at example 4 and example 8 in the 2518 regulations, you see that you can have a different disposition in the event of death and provide for something else in the event of a disclaimer. I've always used it. And in fact, Marty, do we have sample language to show with respect to a disclaimer? We probably.
I don't think we do, but we can make it available, or somebody can email you.
Yeah,
Your email address is on the last slide.
If someone wants it, write to Marty or write to me, and we'll send it to you. But I would urge you to consider putting it in all of your documents. Again, you can't prevent someone from disclaiming. You're just going to decide what happens if they disclaim. There is a case in Orange County, New York, before we adopted EPTL 2-1.11, the New York disclaimer statute, where someone disclaimed, and it provided that when the income beneficiary died, it would go to her descendants per stirpes. Well, she disclaimed, and the beneficiaries came in and said, okay, we're now entitled to the property. And the surrogate of Orange County said, no, no, no. The instrument says you get it when your mother dies. And she really hasn't died, so I'm going to wait until she really dies. Well, we made sure when we drafted EPTL 2-1.11 that you would be treated as though you have predeceased unless you provide otherwise. And you can provide otherwise. So think about, if you had a disclaimer, what would you want to happen to the property? And again, example 4 and example 8 in the regulations under 2518 tell us we have a lot of flexibility in controlling what happens to disclaimed property. You just don't have to treat it as though that person had predeceased.
So the point that I think is a takeaway is, given the uncertainty about retroactivity, we don't know. My gut is I just don't see it happening, not with everything else going on, and I think it's going to be a while before they get to legislation. But there's seemingly little harm in putting in a draft trust, if you're creating a new trust, a disclaimer provision as Jonathan described. Let the client make a decision if they don't want it, but maybe, and this is just a suggestion, maybe the default drafting plan for 2021 planning for every new trust we do is to build in the disclaimer provision so that if there is retroactivity, it gives you a way around it. It doesn't sound from the discussion that we've just had that there's a downside, and it certainly seems like a very simple, inexpensive way to build in a protection in the event of retroactivity. Now, if disclaimers work, as Jonathan has suggested, and they're so simple, why do you need other options to address retroactivity? Well, one of the problems is that lots of our clients, or one of the facts is lots of our clients did trust last year. Lots of our clients did trusts in 2012 and other years. So we have many trusts that may be out there that don't have the disclaimer provision built in. So I guess to introduce the next topic on dealing with retroactivity, the question, Jonathan, is, hey, if I have an old trust and it doesn't have a disclaimer provision, the client doesn't want me to create a new trust, decanting doesn't seem viable, what can I build into the transfer instrument, Jonathan? And then we'll go back to the Q-tip. What can I build into the transfer instrument that can accomplish the protection we want if I don't have a disclaimer provision in the trust?
Well, Marty, that's a great question, and everybody on this phone knows that when you do a will or a revocable trust for a married person, at least if they're in a first marriage situation, in general, you're going to have the trust divided into 2 broad categories. I mean, it may be as many as 4, but it's going to be 2 broad categories. One is a share of the estate, sometimes written as a pecuniary amount, sometimes written as a fractional share, and I will tip my hat in favor of fractional share, where you have an amount equal to the unused estate tax exemption go into basically a family type trust. And the balance will go into a form that's going to qualify for the marital deduction, either outright to the spouse, typically a bad idea if you ask me, or into a form of marital deduction trust, such as a Q-tip trust in most cases. Or you can reverse it. You can have the minimum amount necessary in order to reduce the federal estate tax to its minimum, go to the spouse or a marital deduction trust, and have the balance go into a family trust. But you're using the concept of the estate tax exemption to determine the size of those shares, basically. And you can do that, I believe, also for lifetime transfers, where you would have the numerator be equal to the amount of the exemption available for gift tax purposes, and that will be determined by the credit available under Section 2505 of the Internal Revenue Code, and the balance will qualify, and here it is. Let's take a look at this in some detail. I, Marty Shankman, in consideration of $10 cash, received from Bob Keebler as trustee of the Shankman Family Trust and its successors and assigned, the receipt of which Marty is acknowledging he's got, and $10 received from Patricia Shankman, Patricia Klein Shankman, Marty's wife, my wife, who is a U.S. citizen, the receipt of which is hereby acknowledged, make the following assignments of all my right, title, interest in, and let's say this is a family partnership. Now let's take a look. Why do I have in consideration of $10? It's probably unnecessary, but because there's consideration, it means it's going to be enforceable under state law. The IRS can't come in and say, no, this didn't really happen. No, Marty has received it. It means the transfer has occurred. That's very important. Now, the receipt of which means that it's been received and its receipt has been acknowledged, which means now we have something that's fully enforceable. It was for consideration. It's probably not going to be for in consideration in money or money's worth when we got there. And he's also received $10 from his wife, Patty. And she's a U.S. citizen. The reason we put down she's a U.S. citizen, we don't want to argue that it doesn't qualify for the marital deduction, because for a lifetime transfer, no transfer to your spouse, if he or she is not a U.S. citizen, qualifies for the gift tax marital deduction. So we have it right up front. If somebody looks at this, Patty is a U.S. citizen, we can get the marital deduction. So, you know, we're going to change it, and it's going to be as follows. This gift of the amount is the excess of the donor's gift tax exemption, which could pass to the spouse and which is designated to qualify as a Q-tip, or it could be an incomplete gift. In other words, the part that we've had go to Patty outright could alternatively go into a Q-tip trust. And one of the reasons that you may want to use a Q-tip trust, it gives you extra time to undo it. We'll build in a disclaimer here, but remember, the gift tax return under which Marty would make the election to have it qualify for the marital deduction under section 2523F doesn't have to be made until Marty files his 2001 gift tax return. And on extension, that could be the middle of October 2002. So we've got lots of time to look over and say, to what degree do we want to have this qualify for the marital deduction? An alternative, if you don't want it to go to a Q-tip type trust or to the spouse, is to have it go to what I'll call an incomplete gift trust. And you may want to write this down. Regulation 25.2511-2, paren B as in boy, close paren, fourth sentence, close paren. And that tells you how you can structure a trust in which your transfer to it will be incomplete. So you have an amount equal to the exemption going into this family trust, the Shankman's family trust, and the balance is either going to go outright to Patty, into a Q-tip trust for Patty, or it could even go to an incomplete gift trust. Now, some people say, well, what about a GRAT? Could I have it go into a zeroed out GRAT? Well, there are a number of issues with that. First, can you do a valid GRAT where it's actually zeroed out? An awful lot of practitioners say, no problem whatsoever. I'm a little concerned with that. The other thing is that if you have it go to a GRAT, you probably have to start making the annuity payments right away. And if you don't know what you've got, it's very difficult to know what you should pay. Now, I think you can set it up so you definitely create the GRAT, because you wouldn't have the whole exemption go into the family trust. You'd have the whole exemption, say, minus $100,000. So you know that $100,000 is going to go into the second part, which by premise I've assumed is a GRAT. That way you'll know you'll have it, and what the GRAT owns is whatever has been transferred pursuant to this instrument. And maybe we can argue that if there's a mistake in the amount of the annuity paid, it's only because we misvalued what it owned, and therefore it's still qualified. I think that's an additional danger. I think it works. I'm much happier with a Q-tip trust or an incomplete gift trust. But in any event, the first part, what's going to go to the trustee? That fractional share of the property. Again, this is the family partnership that Marty has created. That fractional share, the numerator of which is the lesser of the entire value of the property, as finally determined for federal gift tax purposes. And it's important to say, as finally determined for federal tax purposes as of the date of this instrument, or the amount of my remaining gift tax exemption. So I'm going to transfer a fractional share to the family trust, the numerator of which is the lesser of the whole value, or if it exceeds the whole value, it's going to be the amount of my remaining gift tax exemption. Again, keep in mind that if you want it to go to a GRAT, you're going to have to say, except for $100,000 or something like that. So you know the grant will be created and will be receiving a transfer under here. So basically you're going to say the numerator is my remaining gift tax exemption. Let's say that's $5 million because you've used, you know, 6.7 million already. And the denominator is the fair market value of the property. Again, it's finally determined for federal tax purposes. And you need to say it's finally determined for federal tax purposes in part because of the relatively recent case of a state of Nelson, in the Nelson case. You need to make sure you say is finally determined for federal tax purposes. So that's the first part. That's going to go into the family trust. Basically, it's an amount equal to the exemption, and I prefer a fractional share. And then the balance is going to go to my wife, Patty Klein Shankman, the remaining fractional share of the property not assigned to the trustees of the Shankman Family Trust. Now, notice what I've done. I authorize Patty individually as assignee of any interest in the property. We're assuming now that she's gotten it outright, and as the principal beneficiary of the Shankman Family Trust to renounce and disclaim any of the property assigned above, and to the extent if any my wife makes such a disclaimer or renunciation so renounced that otherwise it shall revert to me. So Marty can go to Patty and say, Patty, they changed the law retroactively. And even though we've tried to do it, why don't you just disclaim it and we'll try over? Or I can't afford it, or we need to keep that property, or we're mad at the kids and we don't want it to go into the family trust for you and the kids. So you have lots of ways to do it. You should not have a gift tax problem here, even if you reduce the amount of exemption by 100,000, because that's going to go into the GRAT or the family trust. I mean the Q-tip trust or into the incomplete gift trust. So that's another thing you can do. Now, Marty, let's go to the next page. Oh, I'm sorry. I thought there, here it is. Here is where you have some definitions. For example, the gift tax exemption is defined by the credit allowed under 2505. And it means my remaining exemption is the gift tax exemption reduced by the amount of gift tax exemption I've used or been deemed to use prior to that time. You'll notice above in defining the gift tax exemption, it takes into account, taking into account any amendments to the code made by legislation enacted after the date of this instrument, but which is applicable to transfers made on the date of this instrument. So if the Congress makes this retroactive, I'm saying my gift tax exemption will be determined taking that into account. Now, I've had a couple of people tell me you can't do that. They'll never let you get away with being allowed to take into account retroactive changes. Well, gee whiz, are you telling me that the IRS is going to say, even though you didn't know, even though you wanted to give the maximum you could under your exemption, whatever it turns out as of that date, even taking into account retroactive legislation, I can't do it? Well, there are some who say you can't. I just can't imagine the IRS saying you can't do that, or even more so, a court saying you can't take into account changes which the Congress makes. This isn't up to the transferor to change things. This isn't a retroactive change. This isn't a savings clause. It's just that it is whatever it is. Whatever the law tells me it is, that's what I'm trying to transfer. But if you're worried, as apparently some people are, that we've just taken too much risk in providing that we take into account retroactive legislation, don't put in this taking into account any amendment language, which we have here as an example.
So we're going to transition. Bob is hopefully all warmed up and ready to go. We're going to transition, and Bob is going to give us 30 to 45 minutes of planning ideas on income tax changes that might be forthcoming, and very important, what can we tell clients to do now to start to plan for those income tax changes. Bob, take it away, and then we'll go back to some estate planning when you're done.
Well, thank you, Marty. It was, just really fascinating listening to you guys talk about these big picture estate tax things. Before I jump into the income tax, I just want to throw something out there on the estate tax. One thing we've been working hard on, two things. A, should people incur a gift tax, which is really, if you live 3 years, you guys know the drill, it's 40%, but it's really only 28.57%. because of the tax exclusive nature, if the rate is going up to 50 or 55%, that's really easy decision. Secondly, every estate, for any estate tax return that is due now, that can be extended by 6 months, if you could make only a partial Q-tip election during that 6-month period of time, should be extended. Because say Congress changes the rate from 40 to 50%, what we want to do is be able to pay a state tax at the first death. So Grandpa died last year, Grandma's not doing so great, Grandpa left property over the exemption amount in a Q-tip for Grandma. If you extend that Grandpa's return, you might be able to incur tax at 40% of his death rather than at 50% of her death. So put that in the back of your mind. We need to be very careful during this period of time with estate administrations to buy us time to make the best decisions possible. Now, let's switch over to the income tax. Income tax is always driven by tax deferral, income shifting, strangely enough, income acceleration, and income avoidance. Not tax avoidance, but avoiding the income. Now, on the deferral, talk a little bit about CRTs and installment sales. Opportunity zones and 1031 exchanges, of course, are there. And you could argue things like oil and gas might fit in there too, but I tried to stay on the, in the middle of the road and not go over to transactions that pose really high rates of return, but also a lot of economic risks like oil and gas. Now, income shifting, how do we spread income around a family? Because if mom and dad are over $1 million in income and they're going to be hit with this 39.6% rate, they might say to someone like Marty, how do we spread those capital gains across all 7 of our children that are adults rather than stacking all that capital gain up in our return? Now, we'll talk a little bit about income acceleration. This is probably where I've been spending the most time looking at the efficacy of Roth conversions and looking at the efficacy of selling property this year at 20% rather than flying into the eye of the storm and potentially paying tax at 39.6% in 2022, 3, 4, etc. Senator Wyden, who was mentioned earlier in this program, is the new chair of Senate Finance, and he's on the record that that capital gain rate needs to go up. President Biden's on the record that it needs to go up. And the most extreme scenario is going from 20 to 39.6. So that we have to pay very close attention to. Now, on the Roth conversion side, what we're finding out very quickly is as the exemption drops from 11.7 to potentially 3.5, Roth conversions, to some extent, if you can stay within the exemption, become very attractive. If you can't stay within the exemption, you need to use a different technique called IRA relocation, where when insurance agents propose this to you, if you're a lawyer or CPA, be open-minded, okay? Because they have a point. If designed correctly, it actually works. You're going to take money out of the pension plan or the IRA. You're going to pay your income tax, and you're going to jettison that money into a life insurance trust outside of the estate. That math of that works, especially if you're going to be able to avoid estate tax later. That's the key to this. On the avoidance side, opportunity zones, of course, using Section 1202, but maybe in ways you hadn't thought of before, and then looking at, can we move property into a trust in another state to avoid state income tax? And charitable lead trusts can also be very powerful. They are kind of like a Swiss Army knife, because what they do is they not only save income tax, but they save estate tax. Now, big picture shift in policy. We talked about this in other classes, but no 1031 exchanges, 39.6% long-term capital gain. The possibility of a carryover basis or gain recognition event at death. Now, carryover basis is bad, but gain recognition at death would mean if I die with an asset that has a basis of, say, 40 cents, I'm going to have to pick up 40 cents on the dollar. I'm going to have to pick up 60 cents on my income tax return, and I'm going to have to pick something up on my estate tax return, maybe the whole 100% and then get a 691C deduction, or maybe I'll pick it up on my final 1040 and then go from there. Now, The whole thing becomes we need to be ready for that, and undoubtedly that is going to be. I spoke for an insurance company earlier this week and recognize the need for life insurance is going to go up. We don't know what it looks like yet because we don't know where the income tax evolves to. But if the estate tax exemption comes down to 5 or 3.5, clearly a lot more people between 11.7 million and 5 million when we come down that are over 11.7. We know that. We all know that intuitively. Now, big income tax change here. On both itemized deductions and retirement deductions, it's likely we're going to end up with a cap on that benefit at 28%. So your client, Dr. Johansson, she puts $100,000 in her defined benefit plan. If she said to you, how much does that save me? You'd say, well, you're in a 37% tax bracket. You live in Florida, so it's just federal. It saves you $37,000. But the same question next year, you'd answer it saves you $28,000. So if that's really going to happen, we have to start planting the seeds with our clients and be ready on both the itemized deduction side and on the retirement distribution side. Now, for a 30-year-old, they can make up for that negative arbitrage. But for a 60-year-old or 65-year-old, maybe not so, and you would still avoid it. Now, on the retirement side of things, always remember ERISA plans, when there are multiple people in the plan, not family members, are protected from the claims of creditors. And you might have a doctor say, I don't care that there's a negative tax arbitrage. I want the asset protection. I'll live with that. Now, you could also jump in with 401k plans. You could also jump into the Roth world. The estate tax exemption, Marty and Jonathan have briefed out. Remember, rates could be at 45, 50, or 55%. Also remember, for people worth over $50 million, this wealth tax that's being talked about by Senator Sanders and Senator Warren would come into play. And undoubtedly, there will be a set of rules on how you value things. They'll probably look very much like willing buyer, willing seller rules. But we have to know that will change a lot of things, and that's going to be a very hard tax on people with real estate, farmland, etc. And all the techniques that we've been using on the estate tax side for years are going to be modified in some way, shape, or form. Look at slide 32, please. Retroactivity, Jonathan covered this. We'll go up to 33. Now, if you're over 400,000, that's where it's going to start to get ugly. What I haven't talked about yet is the P's adjustment will come back. 199 will probably be phased out over $400,000. And we're going to see a 12.4% Social Security tax on all your income over $400,000. On page 34, let's get into some of this. Now, the capital gains rate, it's only when you make $1 million that this comes into play. So otherwise, the law would stay roughly the same, but at $1 million, you're going to see that kick in. So if I made $900,000 in my regular job, but I sold a piece of property for $150,000, my income would be $1,050, $1,050,000, and the last $50,000 would be caught in this 39.6% trap. Think about what this means, though, if we jump to a recognition event at death, either on your 1040 or 1041, depending where they decide you're going to report that, you're going to have to put this big income. So let's just say you have somebody with $6 million worth of built-in gains, and she is 81 years old in good health. She might come to you and she might say, I've been thinking about this gain recognition event at death. Should I recognize $500,000 or $600,000 a year for the next 10 years till I die so that I can avoid the 39.6? And surprisingly, the answer is probably yes. That's what the calculators tell us. That's what the math and the calculators we built are telling us. Now jump up to the next page. What you need to know about this $400,000 mark on Social Security. Right now, up to 142.8, you pay the 12.4%, then you're done. You never pay it again. The law here would come in at over 400,000. So think of a doctor, she's making $1 million a year. Right now, she only pays up to 142.8, which is arguably kind of a bargain. But the new law would say from 400 to the $1 million earnings she has, she'd have to pay this tax again. And there will be a mad scramble with a lot of brain power from all over the country coming at it of what to do in those situations. Okay, so that's
Well,
going to be a.
Bob, this is Jonathan. Let me just put this in context. So if I make $1.4 million in a year, I'm going to pay that 12.4% Social Security tax on that extra $1 million of income, assuming it's compensation type income. So I'm going to owe an extra $124,000 in Social Security tax. And I don't get a deduction for that for regular income tax purposes. Wow, that's really going to get the attention of some people like you and Marty, who your income so far has been certainly subject to Social Security tax. And now on that extra $1 million that you guys make above 400,000, you're going to pay 124,000 in tax. Wow. And Bob, as you say, what can be done about that?
But Bob, just to make sure people are really off their chairs, when you combine the Social Security tax without limit, state income tax in a high state taxing state, and the new higher income tax rates, what's the marginal rate people, a lot of our clients and many people on this call are going to be looking at?
Oh, let me just do this. I have my calculator. 39.6 plus 12.4. I know you guys can all do the math. So that brings us up to 50%, right? 52%. But then I think there's another 3% on the Social Security side. So you're up to about 55% there. But let's say you live in New York. Now, are you closer to 60, 65%? I think so. And so the need for tax shelter for individuals and creative ways to maneuver around this 12.4 will be a big deal. Now, the simple thing is for doctors and lawyers and CPAs, people that are on the cash basis of accounting, you can be sure if this happens, we will all be great billers, incredible billers in September, October, and November, because we're going to want to get paid before the end of the year when the rate's going up that much. I mean, there will be people doing a lot of things to accelerate that income, selling receivables, etc. Let's go up to the next page. Now, if you're over 400, the 39.6% rate would come back. The thing about this is this calls for Roth conversions, especially for an older person. Look at the page on page 37, Marty. Just check this out. Take a pencil and draw it from the top of the, if you look at 2022, from the bottom of the 39.6 bracket, which is at 400,000, just draw that a straight line horizontally across the page. That puts you at about a 32% bracket this year. There is a great argument that you cannot possibly hurt yourself by converting at least up to the 32% bracket if you're going to be in that 39.6% later, arguably converting up all the way through 35 or 37. The general rule is if you're converting at less than you're going to pay in the future, you should convert. Now, you also want to take into account what will be your rate when you turn 73, 74, 75, and you start taking your RMDs. If we go up to the next page, a couple of ideas on accelerating income. Of course, Roth conversions, Ira relocation, which we spoke about, harvesting gains, deferring loss harvesting, and deferring business expenses. Those are blocking and tackling. By the time we get to the end of the year, we will have a list of 50 things for you to think about. On the estate tax side, just keep in mind that if you're in a state with an estate tax, there is a phenomena under the calculation for 691C, which means even a deathbed conversion in New York would increase the wealth transfer to your family just by jumping into the Roth the day before you died by 10 to 20%. So this is a big deal. Now, also in states like New York and states that have a cliff estate tax, CLIF, meaning if I put $1 over a $2.2 million mark, wherever that line is, I owe a couple $100,000 of tax. A Roth conversion can be very powerful because if you make that conversion early enough so you can actually pay the income tax on it, you shrink the size of your estate. Funding the bypass trust is another great reason. I'd much sooner, if I was funding a bypass trust of $3.5 million, I'd much sooner do it with a Roth IRA than a regular IRA if those are my only choices. And there's another phenomena under secure. The difference between a regular IRA and a Roth IRA, if I let my IRA coast and go all the way to the end of the 10th year before I take it out, you will create per million about another $150,000 of wealth transfer. And that's a strange thing, but it's that during that 10-year period of time, the Roth would not be taxed at all. So every one of us should be mastering the math of the Roth. Look at page 39, please. Now, this Jonathan brought this up. SALT deduction comes back. Let's talk about what we do in the meantime. This is probably what I'm going to do. I'm probably not going to make my April Wisconsin payment. I'll wait till June. I'll pay a little penalty. So what? Anyone that has a big spike in income, you want to wait. If you want to protect them with protective estimates, that's great. But if they owe $5 million of state income taxes and last year they only paid $100,000, get in the $110,000 or $120,000 you need for protective, but wait to pay the rest until 2022 because the SALT deduction is big. If I have to pay $100 to the state of Wisconsin, the federal government is going to underwrite 40 of that, plain and simple. And some little late penalties I may not care about. That's all math. We can run that and compare it. Now, keep in mind on the next page, one of the leading techniques. Yes.
Wouldn't the SALT be capped with the 28%?
Oh, absolutely. It would be caught in the 28%. Excellent point. So, but it's still better than nothing. And but you have to run the math.
They're taking some of the joy out of it.
Yes, they're taking some of the, and P's would come into play too, Marty. So, I mean, we'll have to build a little calculator on that. Now, next page though. The CRT is going to become one of our favorite techniques. Jonathan and Marty have both been involved in dozens and dozens of CRTs. The thing about the CRT, what you need to know is it will be the go-to planning technique beginning in 2022. But right now, be careful with the CRT because for many clients, you'd be better to sell and pay the tax at 20% today rather than defer the tax inside the CRT and not pay the tax until you take it out in 22, 23, 24, 25, because when you pay it out, you might be paying at 39.6%. For the lawyers on the call, it's just important to have the CPA spreadsheet this all out and see see if the strategy is solid or not mathematically. That's what we're really trying to do. And all the rules of thumb for everybody on the call, everything you think you know, you no longer know, or you might no longer know, meaning everything we take for granted of what to do in what situation may be shifting here as this law develops. And I think the rules of thumb which have made practice easy, maybe since 86, the rules of thumb on the Roths since summer of 97, throw all those rules out. Just be very jaundiced when you look at something. Do I have it right? Who do I need to collaborate with to make sure this is right? Who can I read things on that are deep subject matter experts? Now, page 40, the deeper thinking on, yes, go ahead, please.
So one of the things that I'm thinking we're going to also see a lot more of is what we used to call a wealth replacement trust, where you would put highly appreciated assets in a CRT, use it now, and even perhaps more significantly now under the law changes we're anticipating, because the CRT could be used to smooth income to keep some clients below that $1 million level. And then they use a wealth replacement insurance trust to make up whatever wealth may be going to charity. So we may be seeing a lot more of both of those used in tandem.
I think that's absolutely true. And when you're arbitraging 20% against 39.6, you do not, this is my take of this right now. Today, you pretty much need a charitable intention to fund a charitable trust. But if you're just some normal couple and you sell a piece of land for some crazy gain of $5 million, and then you're going to return to your $100,000 a year income and pay the capital gain tax basically at 15%. If you can pick up a 25% or 24.6% arbitrage, Marty, there is no doubt that a CRT is going to work, and you'll be able to have more for your family and be generous to charity while the government gets less. I mean, that's why everyone on this call is going to be just a wizard on how to do CRTs, but in 24 months, I guarantee it. There'll be a lot of learning in this whole area. Let's jump up to the next page. Oh, I'm sorry. Stay right back up one page. I'm sorry. Now, so again, we have the CRT thing. One more page, please. What about how is this going to change how portfolios are managed? Imagine if we have no step up or a gain realization at death. That's going to say to me, especially if there's a gain realization at death, should I be methodically recognizing gains from age X, let's call that 79, from age 79 through 89, when I die, should I be picking up $1 million or $900,000 a gain every year, threading the needle, as painful as it's going to be, at 20%, rather than waiting for that 39.6% rate? Go up to page 45, please. We'll talk a little bit about CRTs. Now, the thing about a CRT is what we generally are looking for is somebody that's charitably inclined. We drop assets into a CRT, and then we sell them later, and the gain is deferred. That's what Section 664 of the code does for us. Very possible also, sometimes state income tax can be avoided depending who the beneficiaries of a CRT are. But the big thing you're doing with a CRT is possibly picking up a lower capital gain rate and deferring, spreading out the capital gain. Page 46, please. So what happens is you have too many shares of one company called Procter & Gamble. You drop them into the CRT, you sell them within the CRT. Now, once you sell them, you can diversify. So not only is the CRT a tax play, but you could argue it's a diversification play, because most of the people that I've helped that have 90% of their net worth in one security do not sleep as well as those that have, 9% of their net worth in 10 or 11 securities. And that's where they want to get to. So the CRT will become very popular. Remember, if you go up one more slide, CRT distributions, if you design it correctly, can be taxed as capital gain. You're going to have some ordinary income, but for the most part, you should be able to manage those portfolios under Section 664 to get money out of Tier 2, which generates long-term capital gain. And it's not the rate when you sold inside the CRT that matters, it's the rate when you receive it. This is why I think we have to be very careful of doing CRTs in 2021 if you're going to be in that 39.6% rate in the future. Page 49, please. Now, one of the best techniques out there for interfamily transactions, you represent Mrs. Johansson. She owns the biggest Ford dealership in your town. It's just an incredible place. And her daughter, who has an engineering degree, mechanical engineering, and then she went for an MBA, her daughter is her right-hand person. And her daughter's going to buy this business from her, and daughter's 32. They decided on the daughter's 35th birthday, she would buy it from her mom on some type of note or something. Well, and they come to you and they go, wow, we can't do this if it goes to 39.6. We like it at 20%, but not at 39.6. Any ideas? And you could sell on an installment note, and in the normal installment note, you'd sell and you'd recognize gains slowly over time. I'm not going to go through all these slides, but in the better technique, Marty, what you would do is you would sell an installment note today, and you would actually have till October 15th, 2022 on an extended return to decide when you want to pay the taxes. That is a pretty powerful thing. Go up to 54 for just a second. I want to make one other, yes.
Bob, would you use the installment sale to a family member or a non-grantor trust, or when would you use that to intentionally trigger a current 20% cap gains rather than just doing a sale to a grantor trust and deferring the gain but shifting the value for estate tax. And Jonathan may want to comment as well.
We've done that a number of times where we'll set up so the client had all of this farmland on the edge of a city. It was worth a lot of money, and he wanted to get a basis boost before he sold. And so what we did is we sold from the grandmother to a trust for the children. And the trust under Section 1001 takes a basis equal to what they paid for it on the installment note. And grandma doesn't pick up the gain until the money rolls in. Now, there's exceptions for depreciation recapture. And there's major problems when it's a depreciable property being sold interfamily on 453. But raw land works. And we sold, and then we waited about 3 years and sold the underlying property. Grandma was still taking the money on the installment basis. That's one way to do it. So, or for this coming year, if you were representing grandma, you might say to her, hey, we need to elect out of installment treatment, pay the tax at 20% rather than 39.6. But the thing about this is you can also, Marty, in the extreme, a person could use the installment method to spread out gains, taking you away from 39.6, possibly bringing you back into a lower rate. And a lot of people, we were able to take from 23.8 by selling over a 10 or 15 year period of time down to a 0% capital gain rate. So there's a lot that can be done here. And I think what happens is the CPAs and financial planners in the long run are going to have to look to a lawyer to draft up these documents. So if the lawyers understand, at least at a triage level, these techniques, they'll be able to see them and see the opportunity. So I think there's big opportunities here. So let's look at income shifting. Now, here's the thing. If we have this crazy capital gain rate that's imposed over $1 million, it would certainly say to us that it might be efficacious. Now we have to watch out for 704C, but it might be it's basically a 7-year rule. It might be efficacious to have a partnership and mom and dad gift the partnership units either to children or to trust for the children. And the beauty of that whole strategy is we can spread the income out across the family. And if we can keep everybody below $1 million, we can avoid that 39.6% rate. What's going to happen here is, in order to do good income tax planning going forward, you're going to have a high degree of knowledge on the estate tax side. There is no way you can do one without the other, because you need to be able to put together partnerships that will work for both income tax and estate tax, that will keep property out of the estate. There is a lot of opportunity. So we can use partnerships for income shifting, and of course there's inherent estate tax benefits for a partnership, and some would argue there's also asset protection values. Now look at page 59, please. The whole idea of income acceleration, what are we really talking about? We're talking about shifting income from a future 39.6 to back to 20, or shifting ordinary income from a future 39.6 back into a 37% bracket. Now, because of, Marty alluded to this, because of the P's adjustment, the new rate going forward in the most benign setting will be 39.6 plus 1.2. If it's wage income, the shifting you're doing is really, for many people, from that 40.8% rate plus the 12.4% Social Security. Don't worry about the details. You're in some crazy 54% rate. And if we can pull that income back into 2021, for every 100,000, you're saving about $12,000 or $13,000. That is very powerful. Now, gain harvesting, very basic blocking and tackling technique. Your client expects to be in a higher bracket later. We sell assets today and pay tax, and we repurchase the same or similar assets. Now, there is no wash gain rule, but no doubt the government could try to use economic substance or try to impose a wash gain type rule, but it would have to be done under judicial doctrines because there's no necessary statutory authority for that. Maybe under 2702, but probably not. Now, this shifts gain recognition of the capital gain from a higher future year to a lower bracket. So the math question becomes, on the surface, on page 62, you would always you would always harvest if you thought you were going to be in a higher rate in the future. That's easy. Let me illustrate this for you. It's December 28th, 2021, and your car breaks, and you need to raise $25,000 to buy a new car. Well, you can raise it today at a 20% rate, or 3 days from now in January at a 39.6% rate. I mean, that's a decision, you know, a smart 7 or 8 year old would be able to make, right? If you brought it that close together. Now, what about looking at a year apart, 2 years apart? The tax is paid at a lower rate, but it's paid sooner. What you can do if you jump up one page is you can put that into a little ROI calculator. And of course, when rates are the same, it's a bad idea. But look at what happens when the rates are jumping. One more page. When the rates jump from 20% to 39.6, you're out over 10 years where it continues to be a good idea. So it continues to be a good idea for a long period of time. So we shouldn't be afraid of this. We should be looking at this and potentially embracing it. Now, going a little further, jump up to page 65 with me. I alluded to this a great deal. Thank you. 66. I'm sorry, Marty. I alluded to this a great deal, but clients are going to have large IRAs. We have largely, I think, and I mean this in the nicest way, I think we've all kind of ignored Roth conversions for the past 24 months with the estate tax exemption so high. There hasn't been a lot of pressure to make us rethink this. But if the exemption comes down, the traditional IRA is not an asset you want to thread through the gauntlet of the estate tax and the income tax. If you're leaving that IRA to charity, then that's the best thing to do. Leave it in the traditional IRA. But if you're trying to transfer it to your family, you have two primary choices, Roth or life insurance. And the Roth and life insurance, assuming you can get the same return, just pretend for a second, you can get the same return in either one, they run the same. If they're running a race, they are tied until date of death. But at date of death, we lose 40% of what's in the Roth, and on the insurance, we wouldn't lose 40% of. So keep in mind, when people tell you you should buy life insurance instead of a Roth conversion or traditional IRA, force them to show you the math. Put those actual policy illustrations into a spreadsheet and show me that I come out better. Now, page 67 and 68.
Bob,
yes.
This is Jonathan. This is something that you know very, very well. Is one of the most horrible parts of having an IRA or even a Roth IRA is that the IRS has taken the position that you can't transfer it before you die. And as a consequence, it's going to be in your estate. It will continue to grow. Maybe, you know, something will just be distributed out, either taxable if it's a regular IRA or tax-free from a Roth IRA. But anything in the IRA, Roth or a traditional, is going to be includable in your estate. And that's a real problem. So one of the other things that you might think about in determining whether or not the client should just give up any sort of IRA benefit, not even a Roth benefit, is to think about the fact that you can make a transfer, get it out of your estate for estate and gift tax purposes.
And that's a good point. And that brings up something pretty scary I haven't talked about yet. So a doctor calls me and he goes, Bob, I have about $40 million in my IRAs and a house worth $400,000. And I just left my lawyer's office and he was telling me how the exemption is going to go down. And it makes me wonder whether I should pull out of my IRA, brace yourself, about $30 million, pay the income tax, and gift away the money. And of course, this scares me to death. I run the math. The math says yes, but it takes tremendous courage to do something like that. And we're all going to be faced with those things in the next 6-8 months. I mean, his idea, which he was mathematically correct, because the exemption is going to disappear, Jonathan, you'd take it out, you'd pay the tax, and you'd give it away using the current exemption. And we're trying to find the sweet spot on that. But there is so much unique math for people that find themselves with disproportionate IRAs. Now, coming back to the Roth conversion, I've taught much of this before. Remember, you're looking for tax arbitrage where you'd be at a higher rate in the future. You're looking for someone with some type of carry forward that might shelter a conversion. And you're looking for the right strategies on Roth conversions. Now, if you're going to do a very large Roth conversion to accelerate income, if somebody says to you, I'm going to convert $1 million to the Roth this year, what you should say to them, I want you to do that in 10 tranches, 3 weeks apart for the rest of the year, 4 weeks apart for the rest of the year. And they'd say, why? And you say, well, I want you to smooth out the volatility of the market. I don't want you converting at a high or a low. You can take some of the risk out of the transaction by spreading that out. Now, the minute you convert, though, you need to, if you convert $100, you need to put $40 on the side to pay those taxes. Because I don't want you converting $100 and then having the IRA fall by half because the market collapses and then have to reach into that half that's left to get the money to pay the tax. We need to be very careful. And the CPAs and the financial planners are going to have to really work together to make sure that we reserve the money to pay the conversion taxes. Don't lose track of that. Now, if we go to page 68, please. Remember, there are also estate tax considerations in the world of Roth conversions. In the perfect world, a person would convert because they'd be at a higher rate in the future, or their children would be at a higher rate because they have outside funds, and because they do not need the money after age 72. And because they can let the Roth run wild. The problem with letting the Roth run wild, if we go with $3.5 million, is we're going to run into that ceiling, okay? And that's going to be, we did this before when the exemption was $600,000. That's why people used a lot of second-to-die life insurance back then. And I think we're going to come back to that. Really, if we had Jonathan's CLE classes from 1975 through 1990 that he used to teach, I'll bet you it'd be fascinating to go through there, because a lot of those ideas are probably right back. They're probably alive again. Okay, and we just have to refine them, polish them up and recycle them. Now, also there's this whole estate tax consideration, and let me be extremely clear on this. In order of importance, okay, if you are living in the New England states, for example, I did one, I know New York wouldn't consider itself a New England state, but where those states up in the Northeast that have a state estate tax, in New York, you pay a 16% tax, estate tax, when you die. That creates an anomaly in the 691C calculation, because you're not allowed to deduct the New York 16% estate tax when you compute your income tax. So you're a really good candidate for a Roth conversion. You also have this cliff issue in New York, which I spoke about. You have funding a bypass trust, and then you have this whole Roth coast that you come out about 12.5% better by coasting for 10 years with a Roth IRA than coasting with a regular IRA, because you don't pay income tax on the growth of the Roth, where you clearly would pay income tax on the growth of the regular IRA. Then, if you go further, there is also this phenomena of the missing 691C deduction. If your IRA grows before you take all the money out, your 691C deduction is frozen in time on the day you die. Think of it as a snapshot on the day you die. There you're holding your estate tax return in your IRA, and you can figure out that the 691C deduction is give or take 40% of the value of your IRA. But if your IRA doubles or triples, your 691C deduction is frozen in time. So it's very, very important to keep that in mind when you run these numbers. Look at page 69, please. And if you go to the triangle, Marty, so what we really need to know is, oops, let me find it for you, Marty. I think it's one more, please.
There you go.
Right there, please. Okay, now, so big picture, somebody says to you, why would a Roth conversion make sense from an income tax planning standpoint? You're going to say, deferral beyond the required beginning date. You don't have to take the money out after 72. And then you're going to have the outside funds to pay the taxes. If you have outside funds to pay the taxes, that is going to make you great. Tax rate arbitrage, that's, you're going into a higher rate in the future, or your children are on a higher rate. Consider that grandma lives down in Boca Raton and her son is a dentist on Manhattan or in Manhattan. Wow. What's the difference in their rate? Grandma's in a 22, 24% rate, and her son is in 39.6 next year, plus New York 50%. Of course you'd want to have grandma do those conversions before she dies. And then you have that 10-year coast. Now, if you jump up to the next page, we kind of look at the estate planning side of this. And state estate tax considerations for 691C and then funding the bypass trust with a Roth is a very powerful idea. Go up to page 70. I want to go up to 74, please. Now, we're not going to cover these today for sake of time, but there is something you should study that I have on 74. That is the missing 691C deduction. You can read that, and then by all means, do the math. I mean, double check my math, proof it out. You'll see, and there I have footnote in my reconciliation proof notes. I have how to proof it out, and then look at the pages all the way up. Even at 76, I shift from the missing 691C deduction to what we're calling the fading 691C deduction. These are important things mathematically to look at. They'll tell you why you're better off. Page 80, please. Now, the question becomes, does a resident of a state with an income tax transfer property into a Wyoming or Alaska trust to pay less tax later, less state income tax later? And the answer is sometimes yes. If your home state will allow you to do that, you should do that. There is another anomaly with IRAs that may work. If I live in California, I leave my IRA to Wyoming trust when I die, and then over the 10 years we pay federal tax. When the money eventually goes back to California under the California throwback rules, we may be able to thread the needle and not pay California tax on the gross amount, but only the amount that goes back to California. That is what most California practitioners are telling me when I broach this with them. So that is a very important idea. The whole idea of using, yes, go ahead, Jonathan.
Bob, let me mention one thing. If you take a look at Revenue Procedure 2001-3, you will see that the IRS is no longer going to issue rulings on ing or ning type trusts. They're not saying they don't work, but it's under study. It's under Section 5 of 2021-3, that revenue procedure. So I think you need to tell your clients, look, we think this works. The IRS has issued over 50 rulings, but they're now studying it. So it's maybe not as assured as it was. And in some cases, people said, well, I'll do it, but only if I can get a favorable ruling. But now you can't get a favorable ruling. At least they won't issue them now.
And that's a very good point, is that we're not sure where that's going, but they have issued about 50 PLRs saying yes. And I don't know how they would change this going forward, but certainly if they want to crush the beast, they'll find a way to do it. So we have covered a lot of ground on the income tax side. I'm going to turn this back to Jonathan and Marty, and they're going to keep going on the estate tax side. So I did put in the materials on a couple of detailed appendices that should help you going forward, and I want you to have those. But Marty, Jonathan, take it away, starting with slats.
Thank you, Bob. Appreciate it. So we have, call it about 45 minutes, 40 minutes left to go. And what we're going to do is talk in much more depth than we did in a prior program on the planning that should be done now. And we're going to try to highlight some practical implications. I think one of the most important things to consider we've already covered, and that's why I put it up front, which is Jonathan's discussion, and I made a few comments about protecting against retroactivity, because that's really something that is pretty unique to 2021 planning. I don't recall ever seeing a tax year where practitioners were as concerned about that. And any of the discussions that we have about planning from here to the end of the presentation, consider those prior comments in context. So SLATs, Spousal Lifetime Access Trusts, I'm sure at this point everyone is pretty familiar with SLATs and we don't need to go through the basics. But one of the concerns, some commentators have raised concern about the significant use of SLATs. One commentator, and I just don't remember his name, made a comment making an analogy from SLATs to FLPs, that SLATs may be the new FLPs in terms of some aggressive behavior and the potential audit risk on SLATs. And that may be true. It may be a problem from the standpoint that as more and more practitioners, especially non-estate planning general practitioners, have been doing SLATs because there's been so much written about them, they may face concerns and issues that we're going to end up having to deal with. Jonathan, do you want to comment, and we'll talk in a few minutes about the reciprocal trust doctrine, but do you want to make some general comments about SLATs that practitioners want to keep in mind, and about the concern with how some people are maybe being a little cavalier about the risks associated with SLATs?
Well, there's nothing wrong with doing a SLAT for your spouse. I just created trust for my wife, and through my wife as the beneficiary of that trust, I'm going to continue to be able to enjoy the property. I mean, that's just, and I'm not going to have it qualify for the marital deduction, so I can use my exemption, and yet the family will continue to benefit from the property as long as my wife lives. The issues come about in two ways. One is, well, what happens if my wife predeceases me? Well, the trust presumably would continue for my descendants, but what about me? So maybe I give my wife a special power of appointment and she exercises it and appoints it back to me. Is the IRS or is it going to creditor say it was always understood that Jonathan would get it back, so it's subject to claims of creditors, or there's an implied understanding that he would get it? And under section 2036A1, you don't need a legally enforceable right. You just have to have kind of a understanding, even an implied understanding, that it would come back to me. So that's one of the issues you face. This isn't where you've done one for each other. The other case is where I come in and I say, well, yeah, I'm doing this for my wife, but again, what about me? We might get divorced. Maybe your exercise of the power won't be effective. So why don't I have my wife do a SLAT for me? And that in turn brings up the reciprocal trust doctrine. Do we have more on the reciprocal trust doctrine?
Yes, we got a lot. I just wanted you to introduce it, and we're going to dig into the reciprocal trust doctrine. Let me just mention, and it's not in the slides, a couple of other points to expand on what Jonathan said. Another issue that many of us saw last year, and we'll see again this year, is the following. Jonathan is going to create a SLAT for his wife, Betsy, and she's going to create a SLAT for him. But gee, before they sat down with their estate planner, they had all their assets, as some clients tend to do, in joint name. So Jonathan, if you and Betsy have all your assets in joint name today, and you each want to fund a non-reciprocal SLAT next week, what happens if we divide that joint account and you each then go and fund a SLAT? Do you see an issue with that?
Well, Marty, let's say I want to do it. We've decided that my wife won't do it. Maybe she's otherwise used the exemption, or we've decided we can only afford to give away 11.7. And even though it's going to go in a trust for Betsy and I can continue to enjoy it through Betsy, maybe we decide that's all we're going to do. But I think it doesn't matter whether I have my own 11.7 million, which I put in trust for my wife, or whether we had an asset which we divided. And in fact, maybe we only have 15 million and we divide it equally. I have 7.5, Betsy has 7.5. Maybe Betsy has to give me an extra $4 million, so I have basically 11.7 million to give away. I don't think the division is a problem any more than if we each owned 11.7 alone. But if I receive something from Betsy and then I in turn around and put it in trust for her, you can certainly make an argument under an implied understanding or a straw person kind of situation that Betsy should be treated as though that amount of money she gave to me, which went back in trust for her from me, is going to cause an estate tax problem for Betsy, or possibly even a creditor problem. The best thing to do, and we've got quite a bit of time before the end of this year, is to perhaps let it sit and cure for as long as possible. Making sure if Betsy gives it to me that I really exercise control over the assets. I change the investments. Maybe I expend some of it for myself. I buy a new boat, a new car, a new plane, whatever. I do the investment rather than having Betsy continue to do the investment. That will show that I really had control over it. So that's one of the things that can be done. Best is if the lawyer can verify that as far as she knows, there was no understanding. It's just that we said divide this, and then the lawyer came back to Betsy and said, Betsy, why don't you give something to Jonathan? That way you'll have more or less equal estates when you die. All of that will kind of help, but there's always a danger there. And of course, the biggest danger, Marty, is where you're going to have the division of the property. But again, I don't think it matters whether it was divided or held separately, where each spouse creates a slat for the other.
Right. So you kind of beat me to the punch with some of the comments, but everything you said is exactly what I wanted to bring out. And I think the one phrase you didn't mention, I'll just mention, is the step transaction doctrine. So if one spouse has 20 million in their name and the other spouse had nothing, and the first spouse gives 10 million to the second spouse, and the second spouse then puts it back into a trust to benefit the first spouse, the IRS could argue a step transaction doctrine is really a transfer by the first spouse, and Jonathan gave you exactly some of the comments, and let me just elaborate very briefly on them because I think it's important. In this very issue of restructuring, retitling assets between spouses prior to transfers is something that we all need to be alert for in doing the gift tax returns for 2020. We need to be alert to those issues now in 2021 and doing planning. The ideal approach is what Jonathan said, is if one spouse has the assets and is going to retitle some of them to another spouse who will then gift them at some point into a slat, ideally you want several months, if not longer, to pass. You would like to change the investments, maybe do a new investment policy statement, mix up the investments, maybe change the character of the investments, and so on. But be alert to that issue. And one of the reasons it's very nettlesome for us as practitioners to find is the client may come to an estate planning attorney to do a non-reciprocal slat plan, and may have worked with their financial advisor who perhaps wasn't aware of the issue, or perhaps neither the client or the financial advisor told the attorney, so that no one really knew to address the remedial steps or the recommended steps that Jonathan and I mentioned. So be alert to that, because I think that's sort of a lingering issue that will affect us this year. And the other point, and I agree with Jonathan, my gut is that we have time to do 2021 planning, and that we're not going to have retroactivity. But that being said, we spent a good chunk of time talking in the beginning of the program how to plan for retroactivity. So I think that a similar comment needs to be made here. If I have a client where $20 million is in one spouse's name and they're going to put 10 in the other, who's going to make a gift to a slat, I would suggest to them that it would be advantageous and recommended that not only do they mix up the assets and change the investments and the character of the assets afterwards, and you may want to set up an FLP or an LLC for one spouse's assets and not others if there's a basis for it. But it would be ideal to have 3-4 months of time pass before any transfers are made. And the problem is, which I would suggest you put the client on notice, let the client make the call. Listen, we don't know the effective date of any new legislation. From a step transaction doctrine, it's preferable that you wait as long as you can, say at least 2 months, 3 months. I don't know that there's a magic time frame, but the longer the better for sure, before the recipient donee spouse makes a transfer into a slat. And the problem is, which the client then has to make their decision what they want to do, is the longer you wait, the better for the reciprocal trust doctrine, but the longer you wait, the greater the potential risk that you miss the effective date of new legislation. So I just think that's a unique 2021 issue, and that's something that we as practitioners should be alert for. Let the client make the decision. It's really their call. We don't have crystal balls to figure it out. Slide 111 lists some of the points that you may want to consider in differentiating slats, different powers of appointment, different distribution standards, maybe having one spouse not a current beneficiary, having this slats created in different states with different trustees, preferably institutional trustees. It certainly has got to be much harder for the servicer or creditor to argue that there is any kind of implied agreement with an institution. It may even be impossible to argue that. Now, we're going to change gears, but we'll come back, I think, to the reciprocal trust doctrine in a second. There's other ways to provide access, and that's something, again, to focus on, because as we discussed earlier, with these large exemptions, unless a client's worth probably 30, 40, $50 million, they're going to want access. And frankly, a lot of clients that we've done planning for are worth more than that because of their high burn rate spending level. They still need access. So a loan provision is something on slide 112 that's included in some trust by some practitioners to provide characterization of the trust as a grantor trust. With swap powers being generally more respected as sufficient, a lot of practitioners, I believe, stopped using the loan power or stopped using it as a backup. But a loan power may be very valuable, not just in terms of grantor trust characterization, which you may not be concerned about, but it's another means to provide access. If Jonathan sets up a trust for his wife, Betsy, and family, if he can get a loan from the trust, let's say he gives me in a non-fiduciary capacity the power to loan trust assets to him for a fair interest rate, but without adequate security. I don't think Jonathan's going to care if he dies owing his own slat money. What he's going to care about is having access to cash flow to pay living expenses, and having a loan provision can do it. Permitting charitable distributions is a way to provide some, if you will, indirect access. Obviously not to pay for a pledge that let's say Jonathan made in his slat, but certainly to make charitable contributions that otherwise may have been paid out of non-slat money. It's certainly feasible to own a vacation home. There's some 2036 issues, and that's kind of beyond where we're going to go today. But I think it's
although Marty,
sure.
Marty, let me add, if I put a summer home in a slat for my spouse, and the trustee says to my wife, you may use this and use it as your own home for as long as I want you to, she can let me stay there. And I don't think you're going to have to worry about the IRS saying, oh, ha, ha, you used it, therefore it's includable in your estate under section 2036A1. Because 2036A1, even if the grantor, and that's me in this case, because I created the slat for my wife, even if I don't have a legally enforceable right. But there's a very important case called Gutchess, Gutchess, in which the court agreed, and this went to the Court of Appeals, and they agreed, and the IRS has basically accepted it now, that if you're using a home that you gave to your spouse or put in trust for your spouse, with your spouse's permission, you're staying there. They're not going to argue that it's includable in your estate. They've respected the family relationship. So I won't worry about putting a summer home or, even a main home in trust for my wife, using my exemption, and yet I can stay there with her. And I hope that she'll either have a power of appointment or get one through a decanting or otherwise, and then continue that trust for me. But again, if you're going to do that, I would wait quite a bit of time before you give the spouse that power of appointment. So they can't say this was all wired, that I would definitely get it back.
So some people feel, and I'm familiar with the Gutchess case, but some practitioners feel a little more concerned about that perhaps than you. And As my mother would say, that's what makes horse races, you know, different views by different people. If anyone listening would like an article on some of the planning considerations for putting, for example, a vacation home in a slat, email me and I'll be happy to send you an article on it. And the final point, which I'm sure everyone's familiar with, but just to say it on the list, is, you know, provide an income tax reimbursement clause, assuming it's not a problem with creditors under state law, and there's plenty of states that it's no issue at all. A tax reimbursement clause is another great way to provide access, or at least to minimize the downside of the grantor trust structure. So there's lots of ways to provide access, and here, courtesy of Interactive Legal, are some sample SLAP provisions that may be helpful for you to consider. So on slide 116, let's just take a couple minutes and talk a little bit more about some of the ways to differentiate SLATs. Although I think one of the most significant ways, Jonathan and I will discuss in a few minutes, which is building in SPAT or other types of powers, which make a significant difference in how the trust, I believe, is going to be viewed in terms of reciprocal, the non-reciprocal nature of it. But one of the key concepts on 116 that you see in some of the cases in the law is you don't want the spouses in the same economic position following the creation of the two trusts. So if you had two identical trusts and each spouse put in 11.7 million of marketable securities and each is a beneficiary of the other trust, the argument is in that extreme case, there has been no change in the underlying economic position. But if you have different assets in each trust, different terms, as we've already talked about in each trust, different state law, different trustees, you can also mix up the assets. So for example, you know, maybe for simplicity's sake, the bonds go in one trust and the family business in another trust. Those are certainly different economic positions than when each spouse owned those assets previously. You may be able to use insurance, not only to address the mortality risk, but to mix up the economic position. So if each spouse put 11.7 million in a trust, but one of the trusts had an insurance director or insurance trustee and provisions to hold insurance and bought a $5 million policy on the donor settlor spouse, arguably that puts the donee beneficiary spouse in a very different position because of the significant insurance policy in the trust. Different distribution standards, different trustees, different powers of withdrawal. Jonathan, you want to comment on some of the powers of appointment and how that may be used on 117?
Yes, there's a very important case that we have cited here, Estate of Levy, which is a 1983 tax court case, which was cited with approval by the Internal Revenue Service in '96. Mr. and Mrs. Levy, who were residents of New Jersey, created identical trusts with the identical assets and the identical terms with the identical lawyers on the identical day of the year. There were no differences, and Mr. Levy up and died, and the IRS thought, man, this is duck soup. We're going to have the reciprocal trust doctrine. But Mr. Levy's estate pointed out that Mr. Levy had given Mrs. Levy a broad lifetime special power of appointment, and she had not given one in the trust she created for him. The IRS conceded in its brief that if the power of appointment was valid under local New Jersey law, that the reciprocal trust doctrine should not apply. The court found that the power of appointment was valid in the trust that Mr. Levy had created Mrs. Levy, and therefore it didn't apply. However, there are many practitioners who feel you cannot go that far. You need other distinctions. But giving one spouse a lifetime power of appointment and not the other, and maybe like my wife and I did, I also gave her a testamentary power. I gave her the ability to have everything converted to a unitrust, but that was prohibited in the trust she created for me. In fact, I wasn't even a beneficiary of the trust for quite a period of time. Also, Betsy could exercise her powers of appointment immediately, but it said that any power of appointment I later got would have to wait at least 5 years. Also, in one of the slats that we created, we provided that for 5 years, only our grandchildren would be eligible beneficiaries of the trust. And it would only be later that my children and I would come back in as a beneficiary. Now, the other important thing that you want to do is to have as much time between the transfers as possible. That means we hope you have until the end of 2020. It would be great if you could go to a different tax year, But I think that we will find out that a lot of the planning we want to do, including the size of the exemption, is going to disappear or be dissipated next year.
But again, be careful, and this is somewhat unique and different to 2021. I like the idea of having several months or longer between the establishment of each trust and the signing and the funding of each trust. But let the client take on the decision. Gee, if you know, the longer I wait, the better it is to deflect a reciprocal trust challenge. But the longer I wait, what if Jonathan's prediction that he just made that we'll have this year to do planning before the laws change? What if that's wrong, and in June a tax law is passed? So let the client take that on. The next couple of slides elaborate on some of the things that we talk about. Bottom 119, and this is something that for many clients may not be that hard to do. Add in a parent in one trust and a different family member in the other trust. So mix up the beneficiaries. Often that's not that hard to do. I think that these slides will give you a whole bunch of different thoughts and interests. 112, I talk about varying the assets, which we've already talked about, and ways to do it. Now, one of the other questions, and Jonathan kind of alluded to this before, is should both spouses fund slats? Clearly, if the estate is a $40–50 million estate and the client is comfortable, and that's obviously critical, making the transfers, why not use up all the exemption? Because if you use every penny of the current temporary exemption, you've now secured that exemption very likely if there's any change in the law. But for a lot of clients that are, let's call it, and I apologize for the term, moderate wealth relative to the exemption, a $20–30 million estate, they're not going to be comfortable putting 11.7 times 2. And I think the knee-jerk reaction, which is illustrated on 122, is that, okay, let's say they're comfortable, they have a $16 million estate, each spouse is willing to put in $4 million, which overall is a very significant percentage of their assets. It's half their wealth that they're putting into the trust. Does that make sense? And the answer is it may not make sense, even though it's sort of conceptually or knee-jerk reaction by many clients is that it makes sense. They may be much better off having one spouse put in $8 million, the other spouse do nothing, because if the exemptions drop to $3.5 million, one spouse is secured $8 million minus $3.5, you know, the excess exemption of theirs that they've used, and the remaining spouse who didn't make any transfers still has $3.5 million. So we need to evaluate how many slats we're doing, if we're doing slats. And in many cases, it's going to be preferable for more moderate wealth clients to do one trust instead of two. And hey, no client's going to complain having half the cost and half the administrative hassle in doing one trust instead of two. Jonathan, why don't you talk about the pros and cons of doing adapt and why they specifically make sense to encourage clients, or to help clients, let me rephrase that, to help clients feel comfortable making a larger transfer to use more of their exemption?
For a variety of reasons, you may want to not do slats. First of all, you know, you may not be married, or you and your spouse are going to keep things completely separate. But you can do basically slats for, say, it's not going to be an S for spouse, but say for a sibling. In fact, the first reciprocal trust case of any note for tax purposes involved two Lehman brothers. They created identical trusts, same assets, and so on and so forth. And the tax court and then the Second Circuit Court of Appeals held that when the older brother died, the trust that the younger brother had created for him, and which he had an income interest, would be includable in his estate, because basically you'd switch the trust. So you can do that. But if you don't want to use a slat, let's say you say, you know, I have no one I think I could responsibly do a non-reciprocal transaction with, you can create a trust for yourself. Now, throughout the United States until 1987, if you created a trust for your own benefit, even if you were only a discretionary beneficiary, you weren't trying to bilk anyone, you just wanted some ability to have the assets available for your use, even with an independent trustee, even without any sort of understanding. The law throughout the United States said that that trust was permanently subjected to the claims of your creditors, even if for a creditor that wasn't foreseeable and who arose 20 years down the line. And the IRS has consistently ruled that if you have a trust which is subject to the claims of your creditors, There's a 1954 revenue ruling, which has been supported by case law, that says that that means it's a grantor trust, and more so that it's includable in your estate because you have the ability to benefit from it. There are lots of cases. One of the most important ones is a case called Paolazzi, which decided out of Massachusetts law. There's also Revenue Ruling 76-103, 77-328, and 2004-64. So if you create a trust in the United States before 1987, it's going to permanently be subjected to the claims of your creditors, which means it's going to be in your estate. I thought that we ought to have a state in the United States which would allow you to create a trust for your own benefit, but not permanently subjected to the claims of creditors if you are not trying to bilk a creditor in doing that. And Alaska passed such a law in 1987, and now we have 19 states in the United States, including Delaware is a very common one, South Dakota, we now have Connecticut, New Hampshire, Wyoming, lots of states now permit you to create a trust for your own benefit. And if you're not trying to defraud or hinder or delay a creditor, that is not going to be subject to the claims of your creditors. Now, there's another thing you had to worry about, and that's Section 548E of the United States Bankruptcy Code, because after Alaska passed the Alaska Trust Act, allowing you to create a trust in Alaska, but not subjecting it to claims of creditors, the banks got concerned. They went to Congress, and Congress passed 548E, which says if you go bankrupt within 10 years of a transfer to a self-settled trust or a similar device, whatever that is, then it's going to be includable in your bankrupt estate and go to your creditors. But the creditor has to prove that you intended to hinder, delay, or defraud a creditor. So if you're not trying to hinder, delay, or defraud a creditor, you're just trying to do good estate planning. And I think between you and your counsel, you can establish that that was the reason for the transfer. In almost all cases, you don't have to worry about Section 548E. So what this means is that you can go to a state like Alaska or Nevada or South Dakota and create a trust for your own benefit. And that means that you should not have those assets includable in your estate. Now, a lot of states try to make their statutes of limitations for a claim even to be made very short. Ohio, I think it's only 18 months. In New York, in Alaska, it's 4 years. That doesn't really matter, because you're not trying to hinder, delay, or defraud a creditor, and the time isn't going to change what you're doing for estate tax purposes. So choose a self-settled trust jurisdiction like Alaska or Delaware or New Hampshire or wherever, Ohio, wherever you want it to be. But keep into account a couple of things. Choose a state that does not have an income tax. Even though it may be possible to avoid the tax, if you make the trust subject to the laws of one state and you have a trustee there to ensure that you will be respected for that purposes, you run a risk of state income tax when it's no longer a grantor trust. So that's something else to keep in mind in choosing your jurisdiction.
So one of the things that I think is really important about the DAP conversation is the following. If you do have two spouses, and clearly if you have a single client, a client who's single or not planning with their spouse because it's a second, third, fourth marriage, etc., a DAP may be worth exploring. But I think there's another opportunity for not only DAPs, but hybrid DAPs and SPATs that we're going to talk about, which is why are you doing two non-reciprocal slats, wondering if you're going to jump the hurdle of a reciprocal trust challenge. If one of the trusts is structured as a DAP and the other trust is structured as a slat, or a DAP in a slat, or a SPAT in a slat, I think you've made a significantly material differentiation between the trusts. So consider when you're trying to do 2021 planning, a DAP and a slat gives you more access than two slats, and it also is significantly different. Jonathan, one of the issues that comes up when you have conversations with some practitioners is, gee, DAPs don't work. The Renson case in Florida, New York, and other states have a public policy against them. The Cleopatra case is being argued. Are DAPs as dangerous as some feel or worry or are concerned about? How does a practitioner get comfortable looking at a DAP who may not be comfortable?
Well, Marty, there are no guarantees in the law, of course, and there are some bad cases out there where people, I think in almost all cases, were trying to hinder, delay, or defraud a creditor. But if you can establish that you were doing this for estate tax planning purposes and understanding that the curtain on using a big exemption probably is going to be drawn very soon. And let me relate what happened. After the Alaska Trust Act passed, I was invited by the bankruptcy judges of the United States, they're all federal judges, of course, to meet them at their annual meeting, and I did. And they said, well, what's the story with the Alaska Trust? Are you trying to have a way that we can hinder, delay, or defraud creditors? And I said, no, that was not my motivation. My motivation is that when you try to get someone to give property away, it's typically an anathema, even if it's for members of his or her own family. And I felt if I could have a state in the United States which would allow someone to continue to allow the grantor, the former owner, to enjoy the property, a lot of the resistance in doing good lifetime planning, which is typically the very best estate planning you can do, would go down. And they all said, all the judges, there were probably 5 or 6 of them that were active in this conversation, there were probably 30 or 40 of them there, said, if you could establish that the purpose was to do legitimate estate tax planning, I wouldn't think about drawing that trust into the bankrupt estate. So, you know, that's very good news. Can you be sure? No. But again, there are a lot of things you can do to try to use it. And asset protection planning is completely legitimate. It's just you have to do it in certain ways. And the United States is probably the toughest jurisdiction in the world when it comes to creditors having attachments. But I don't think I would be concerned if I had a client come in and said, I want to do some good planning. What can I do? You talk about exemptions that exist under state law, like in Florida, your home, basically without limitation. IRAs and qualified plans in virtually all jurisdictions. California, of course, is an exception. Life insurance and annuity products are almost completely exempt in many, many states. All of those things can be done. And then you may want to roll out something like an asset protection trust if you're trying to do asset protection planning. But if your goal is to do estate planning, but have the ability to get it back, I think it's perfectly fine to use a self-settled trust in one of these outstanding jurisdictions. Just make it clear that you're doing it for estate planning. And as Marty said, make sure, and in Alaska and in some states you have to, get an affidavit of solvency from your client. In fact, you ought to make it very clear from the records that you maintain for the client that this was for legitimate estate tax planning, not to bill creditors.
And I think there's a lot of steps, and we went through them earlier in terms of getting a financial analysis done, making sure there's adequate life, casualty, liability, property, disability, long-term care, and other insurance coverages in place, getting the affidavit that Jonathan mentioned. We went through a whole list of things that you can do that I think really can help demonstrate that at the time of the transfers, there was no intent to delay a creditor. In fact, with the lien judgment and other searches, that no creditor was even known at the time. So there's lots of steps that can be taken. I think some practitioners dismiss DAPs when maybe in fact they're worth considering, and I'm not going to suggest that's wrong, but I think the client can make the decision. And as Jonathan said, there are no guarantees. There's always uncertainty. But if the client really wants that extra degree of access, being a beneficiary, and the SPAT, which we're going to discuss in a few minutes, doesn't work, a DAP may very well be worth considering. If anybody listening wants some materials on DAPs, Jonathan and I did an article on the Klobaka case and a couple of others that we can send you if you email us, if you want to see some of the discussion of some of the bad fact cases and how you may differentiate the planning that you're doing. Slide 127, there's a number of ways you can also sort of rein in or limit the DAPT, which may make it safer. So for example, the 54080 of the bankruptcy code that says the bankruptcy trustee can pierce or disavow the transfer to a self-settled trust or similar device, make the client not have any rights to be a beneficiary for 10 years and a day. So you're outside of 548E because the client has to wait more than 10 years before they can even become a beneficiary. If the client, the settlor, is married, prohibit distributions to the client while they're married because they can indirectly benefit, as Jonathan explained earlier in the context of a slat. There's a whole range of steps that can be taken to circumvent and limit perhaps some of the risks, although they certainly can't be eliminated, but they may be reduced in using ADAPT. And courtesy of Interactive Legal, there's some sample provisions. Now, one of the approaches that a number of commentators have recommended is a hybrid DAP. So if the client or you as the practitioner are uncomfortable doing ADAPT, what about a hybrid DAP? What's a hybrid DAP? So I'm going to give Jonathan the power in a non-fiduciary capacity, and I'll let Jonathan talk about the I-Naughty case in a minute. But I'm going to give Jonathan the power to add me back as a beneficiary of the trust. What does that mean? Well, the trust today is it's hard to argue that it's a self-settled trust because I'm not a beneficiary of the trust that I created. My spouse and children are, so it's really a SLAT, not a domestic asset protection trust, because I'm not a beneficiary unless Jonathan adds me back. Now, you can take further steps, which probably don't even require any incremental drafting, in the following way. Let's say there's $5 million in this trust that I created, and I feel, some number of years from now that I really need access to some money, let's say more than 10 years in a day, so I'm out of 548E. And I tell Jonathan, boy, I could really use some help on cash flow. And Jonathan, before he does anything, has Peak Trust, who's the trustee of my DAP, divide the trust, and almost every trust has general powers to do it, and state law may prevent it if not, and puts $1 million in one trust and $4 million in the other. And he only opts to add me back as a beneficiary of the $1 million trust, so that arguably the bulk of the wealth is still immune from being characterized as a self-settled trust. Now, one of the things that, so that may be a way to do it. And some practitioners will do it that simply and give Jonathan the right to add me back. Others will give Jonathan or whoever that power holder is the right to add back descendants of my grandparents. So it's a larger class of people, and I'm only one possible person in the class, and that may be a further step towards safety. Jonathan, why don't you talk for a second about the I-Naughty case and how and why people may want to structure hybrid DAPs to address that concern?
In the I-Naughty case, the New York court held that the person who created the trust was a beneficiary of the trust and therefore would be denied benefits that were not available if you had a self-settled trust, where the grantor could be added back in as a beneficiary by the trust protector. Now, the trust protector happened to be a fiduciary. So if you want to go this route, I would strongly recommend, and I know Marty agrees with me on this, that you not allow the trustee or any fiduciary to add the grantor back in as a beneficiary, but have some independent person be able to add the grantor back in as a beneficiary. This removes you from the I-Naughty case itself, but there's still a risk that a court would say, no, Jonathan, because you could be added back in as a beneficiary, we're going to consider it to be a self-settled trust and deny government benefits or make it subjected to claims of creditors. If you go this route, again, I would start in a DAP jurisdiction like Alaska or Delaware or South Dakota or New Hampshire or Nevada or someplace like that. I would not do it in a state that doesn't have DAP jurisdiction, jurisprudence like Florida or New York or California. Don't do them there and say, well, you can add the grantor back in and we don't have to worry. I think you are really taking a great risk, even if you say it can only be added by a non-fiduciary.
Let me just step out of sequence for a second, because Jonathan made a good point that maybe it's worth just a minute of discussing on slats. I very much agree with Jonathan's comment in terms of using a jurisdiction that permits self-settled trust, and many of those jurisdictions have more favorable tax rules and so on. And for those that have not frequently used better trust jurisdictions, it's very easy to find co-counsel that will review your trust document to make sure it complies with state law in South Dakota or Alaska, wherever you are, Delaware. Lots of lawyers will be there and happy to help you, and it's not that much more expensive for the client. There's an array of outstanding trust companies in these jurisdictions, both full service trust companies, especially in Delaware, and administrative trust companies that have very competitive, very reasonable fees in the other jurisdictions. So when Jonathan suggests that you have situs in a better jurisdiction, from a practical and cost perspective, it's really not that hard to do, and nobody should shy away from it. Question, so if I'm setting up, and now we'll be out of sequence for 1 second, if I'm setting up two non-reciprocal slats, my wife and I each set up a slat for the other, we drafted in lots of provisions. My wife is the beneficiary of my slat and gets a $50,000 distribution. And what she would do, which most clients would do, we actually can't do because we don't have this, but most clients do, she would deposit that check into the joint checking account. If I sit down that weekend after she got this distribution and I start paying bills and my personal expenses and my personal living expenses out of the joint checking account, do you think there's an exposure with that, Jonathan, of the IRS or a creditor arguing that I've now benefited from the trust that I was not a beneficiary of, the slat?
Well, Marty, you never say never, but I think that, again, if I create a slat for my wife and she receives the distribution and she decides to expend it for the family, I think it's going to be a very tough case for a creditor or for the IRS to contend that it was understood between my wife and me that she would basically get the distribution and hand it over to me. Obviously, you should not do that. You shouldn't have the wife receive the distribution and hand it over to the husband. You should have her have it herself. She puts it in her own account. I wouldn't put it back in a joint account right away. Put it in a separate account. If she wants to pay things, that's great. That's what husbands and wives do.
So I think that's just sort of an important comment in terms of administration of the trust that we create, which too often clients don't come back and let us do. But another way perhaps to address that is if the slats were created in a trust-friendly jurisdiction with an independent institutional trustee, and let's say they did put the assets in a joint account and somebody attacked it, Jonathan, and I guess this is a question, would the trust perhaps, if it's met the requirements of being a self-settled trust, still perhaps work if you're in a jurisdiction that permits them rather than in one of the jurisdictions that does not?
Marty, you were cut off for a moment. Could you repeat that question again?
Sure. So the thought is, does that provide a safety net, a backstop? So if my wife gets a distribution out of the slat that I created and puts it in a joint account and I expend it for my benefit, and somebody attacks that, the IRS or creditor, saying that, I clearly had an implied agreement, I'm benefiting from the money in the trust that I'm not a beneficiary of. If that trust, instead of being in New York, for example, were instead in Alaska and met the requirements to be a self-settled trust, would that suffice? In other words, the backstop argument would be, okay, we administered this trust, this slat, incorrectly, and one of the spouses got benefit from the funds that the other spouse was a beneficiary of, but it would qualify otherwise as a self-settled trust?
Well, sure, Marty. I mean, let's say you create a trust for Patty. Patty gets a distribution. She puts it into a joint account. You start expending the money. The IRS says, aha, it's basically a self-settled trust. And if it's a self-settled trust under New York law, it's subject to the claims of your creditors, Marty. You're the grantor. So if you have it in Alaska or South Dakota or Delaware or Nevada or someplace else, even if they can argue that it is self-settled, if you fall under the provisions of that particular state's law, it still shouldn't be subject to claims of creditors. Understanding that some people believe that no matter where you create it, if you live in a state that does not respect self-settled asset protection trusts, you're dead in the water. But that's certainly a good thing to do. I mean, it's going to be pretty rare if you're trying to create a trust for your spouse and you think you may benefit from it. You really need to consider doing it in a DAP jurisdiction.
So, Jonathan, the next topic, which is something that you kind of created with Abby O'Connor and Mitch Gans, on slide 134. Why don't you explain SPATs and why they may be a better option, or certainly a different option? And everyone, while Jonathan explains this, keep in mind, if the plan initially is non-reciprocal slats, you can make a slat and adapt, you can make adapt and a SPAT, you can mix up the acronyms and further differentiate the trust. So think of it, as really in that sort of broad context. Jonathan?
Yeah, a SPAT is a special power of appointment trust, and it works the following way. I create a trust for my family. It may be my wife and my kids, or just my kids, and I'm not a beneficiary. In fact, I'm going to provide that I cannot be made a beneficiary through a decanting or otherwise. And I'm going to provide that the trustee can never make a discretionary distribution to me. So it's not a self-settled trust, which takes me out of the scary parts in many, many states. So it's not a self-settled trust, but I'm going to name someone. In fact, if it were me, I'd name 3 people who will hold a lifetime special power of appointment, exercisable in a non-fiduciary capacity, to appoint any part of the property they want to any descendant of my mother. Now that class would obviously include me. Now, if I give this power, say, to Marty, and Marty could go ahead and exercise it in favor of any descendant of my mother, including my brother Doug and his kids, and me and my grandkids and my children, Marty might get mad at me and say, I'm going to hurt Jonathan and I'm going to appoint it to his brother Doug. So what you also want to do is to say that Marty can only exercise the power with a prior written consent of my lawyer. That way, I don't think Marty is going to go crazy. Now, can I be sure that if I want something, I go to Marty and I say, I need another $250,000 because I need a new yacht or whatever it is, or a new plane? Marty might say no, but that's why you may want more than one person. You could have 3 people, and indeed, maybe you want to go and say that any one of those 3 people can pass that non-fiduciary lifetime special power of appointment to someone else. So Marty might say, if I die, I give it to my wife, Patty. Again, I'm pretty protected from Patty trying to hurt me because she's going to have to get the consent of my lawyer or my law firm. And again, this is by definition not a self-settled trust, because a self-settled trust is in which you can get a distribution in the discretion of the trustee, or as Ionati said, maybe with another fiduciary. But here, they are prohibited from making any distribution to me. It's only by the exercise of a lifetime special power of appointment. And the law seems abundantly clear that no court can order an individual to exercise a special power of appointment in a particular way. So that's one of the things I would do. I think, I'm the guy who invented lifetime DAPs in the United States. But I think this is really better. In fact, maybe you have one spouse create the slat. I create a slat for my wife, and she then creates a SPAT. And the SPAT would say that it could be paid to any descendant of her mother, which would include her, or anyone who is married to or has been married to any descendant of her mother. That way I can benefit. And again, I would recommend maybe you put in 3 people, but I think that the SPAT is a great idea. And in fact, rather than doing 2 different slats, I would do 1 slat and 1 SPAT, or do 2 SPATs, have each spouse do it. And again, I would do it in a DAP jurisdiction just to get as much mileage as you can away from having someone argue that you're subject to the rules that say a creditor can attach assets in a self-settled trust. This is by definition not a self-settled trust.
So on slide 136 and 7 is a sample SPAT provision courtesy of Interactive Legal for those that want to see what the actual drafting looks like. So let's change gears and talk about GRATs. Everyone I'm going to assume is familiar with GRATs. Everyone is quite aware that in the current very low interest rate environment, the hurdle you have to exceed to shift upside appreciation outside of the estate with a GRAT is very low. So GRATs can be a very effective tool. I think the most important point right now is if clients have not used their temporary exemption, GRATs are not really the right tool. I can't think of a situation where I'd want to use a GRAT maybe other than a spillover on a defined value mechanism. But I would not really be using a GRAT if we haven't used exemption. Use some of the other things that we've talked about first to lock in the client's exemption so it's not lost. But if a client has already used all of their exemption, a GRAT may be a very effective tool in the current low interest rate environment to shift value out of the estate. What's different about GRATs in the current environment? Well, if these tax changes that we have talked about and are the premise of this whole program come about, a number of the Democratic Party proposals, the Sanders bill, the Obama Green Book, have included incredible restrictions on GRATs. On the bottom of 139, if you have a minimum 10-year term on a GRAT and that the gift will be a minimum of 25% of the value contributed to the GRAT, I can't think of too many circumstances where you'd want to use GRATs in that type of situation. In effect, those restrictions would basically eliminate the use of GRATs. What does that mean to how we do GRATs today? Well, the traditional application of GRATs is to have short-term, say 2-year rolling or cascading GRATs. Put a separate asset class or separate security in each GRAT. If that particular asset increases above the 75/20 weight, you got to win. You've shifted value out of the estate. If the particular GRAT does not win, well, then it's a zero result. It's like heads you win, tails you don't lose, and the assets would just revert back to the estate through the GRAT payment. But the way we've done GRATs traditionally is I'll set up a bunch of GRATs now. And why do I say a bunch? Because given that there's a win on upside volatility above the 75/20 rate, but if you lose the bet and there's a decline in the value of the GRAT assets or they don't exceed the 75/20 rate, you don't want to blend all the different assets in a single GRAT, because then the winners offset the losers. The winners offset the losers, and you end up with not the same net gain. So you're going to do more granular GRATs. So let's say you did a half a dozen GRATs. But the issue was that the presumption was that if next year when I got my payment, and you could defer the payment for 105 days under the GRAT regs, I would then take that payment out and re-GRAT it and just keep the process rolling and just keep doing new GRATs, and hence the name rolling or cascading. But if the law is going to change, and we've speculated sometime this year, perhaps the beginning of next year, we may never have the ability to roll or cascade the GRATs we're creating now. So on slide 141, one of the things you might look at doing is, yes, GRATs are great. They work wonderfully to shift upside volatility out of the estate when you can't use much exemption. And Jonathan, I think, made a comment earlier. If not, forgive me, I'll just say it now, that you may want to have a very modest dollar value of the gift to report on a gift tax return instead of a full zeroed out GRAT, and different people have different views of that. But maybe what you want to do is a ladder of GRATs, a 4, 6, 8, and 10-year GRAT. Or if the client's younger, a 6, 8, and 12 or 15-year GRAT. And the reason for that is, why not lock in the benefits of a GRAT mechanism with the current really low rates if you can't roll them or cascade them in future years? So that's a very different way of viewing GRATs than what we've traditionally done. And it would seem to me that, given the unique environment where we're all anticipating a change with much harsher rules, that may be a preferable approach for some clients. And by the way, and I know we've mentioned insurance in a positive light a number of times, and here's another one on slide 141. If you're doing an 8 and 10-year GRAT, maybe you want to match a term life insurance policy, the term of the GRAT, so that if some portion or all of the GRAT principal is returned to the settlor's estate because of a premature death, you have the wherewithal to pay the tax at least attributable to that. Now, there may be another unique application of GRATs in 2021. And this may be sort of a Hail Mary pass of a long shot throw if the client feels the law is going to change, or if there's an announcement of a law change and we have a little time before the effective date. Jonathan, you want to explain, and I think this was Turney Berry who originally proposed it, but it's a very clever idea. Do you want to explain the 99-year GRAT?
Yeah, this is an idea that Turney Berry from Louisville, Kentucky came up with, and it's a really great idea. You create a GRAT and you come as close as you want to zeroing it out, although I recommend you leave at least a smidgen there. And in fact, we have formulas to try to make sure you don't go too low. But be that as it may, you create a GRAT and you provide for the payments to go to you or your estate for 99 years. And Turney one time heard me say do it for 100 years, but he said that's just too aggressive. That's a joke, of course. Whether you do it for 80 years or 99 years or 100 years, the one thing we know, you are going to die before the GRAT is over. And that means a portion of that is going to be includable in your estate. But it's not necessarily the whole thing that's includable in your estate. What you do is you take the annuity and you divide it by the Section 7520 rate that's in effect at the time you die. So for example, at the bottom we see here is that I'm going to have a trust to pay me, put in $1 million, it's going to pay me $11,000 a year for 99 years. And with a low Section 7520 rate like we have right now at 0.6%, it's going to come pretty close to zeroing it out. If when I die, it's still that rate, go back one slide, Marty. If it's still say 1%, it's gone from 0.6 to 1%, you'll take the $11,000 annuity, divide it by the then 7520 rate of basically a 1%, which is dividing it by 0.01, which is the same thing as multiplying 11,000, the amount of the annuity, by 100. So 1,100,000 is includable in my estate, but it can't be more than the value of it. But let's go to the next page, Marty, and see what happens if the interest rates rise. If when I die, the rate has risen to 5%, we still take the 11,000 annuity, and now instead of dividing it by 1%, we divide it by 5%, which means we now have includable in my estate $220,000. Now remember, we put in $1 million. So even if the value of the trust hasn't grown, we paid out $11,000 a year, the only thing that's includable in my estate is $220,000. So if it's worth $1 million, I've now gotten $780,000 out of my estate, completely free of gift tax entirely. And even if it's only worth $500,000, I'm still going to get, $280,000 out of my estate. And if it's grown, say, to $5 million, I get everything but that $220,000 out. So if the interest rates rise, and I'm going to tell everybody on this call, and please don't tell anyone else about it. This is a secret which I'm telling you. Someday interest rates are going to rise. And
Wow.
it also, I know, Marty, it's hard to believe, but let's say they arise 15 years from now, I'm still alive. And, does this have to wait until I die? No. If the interest rates rise, what you can do, at least under current law, you could sell your annuity, say, to the trust that's going to receive the remainder in the GRAT. And if it's still a grantor trust, this trust which you created, which is going to receive the remainder when the GRATs end, you now sell your annuity to that. There's no gain, at least under Revenue Ruling 85-13, as the law exists now. Now that trust will hold both the remainder and it will hold the annuity. And under the law of most states, those things will merge into a fee. So the trust pays me, if the interest rates are now up to 10%, the trust pays me $110,000, but it's going to have the excess, which, might be several millions of dollars. Again, there's no real downside here. And one of the nice things for your client is she can continue to receive payments for as long as she wants.
So let's change gears and just for a couple of minutes, make a few comments on note sale transactions, a commonly used planning technique that many know about. It's certainly something to evaluate for clients with sufficient wealth that just merely making gifts of the exemption amount is not enough planning for them. We've said earlier that on the chopping block are discounts and potentially having a GST tax assessed 50 or every 90 years on dynastic trusts, having assets and grantor trusts included in the estate. We have no idea how those kind of changes may be enacted. There's certainly a possibility, though we certainly can't estimate it, that those changes may apply to trusts or transfers to trusts after the date of enactment. So if that were the case, any kind of note sale transaction could be huge. Now, one of the things that people are evaluating and should be evaluating is if you have a large Q-tip, you know, can you get assets out of that Q-tip and then have the surviving spouse beneficiary sell those assets and try to lock in some of the discounts and shift valuation increases out of the estate because of the potential worsening of the estate tax. And that's certainly a transaction to look at. Be mindful of 2519 issues. Could the IRS challenge the distribution of assets out of the Q-tip to the surviving spouse and the surviving spouse selling them as being the equivalent of her giving up some portion of her income interest under 2519, thereby triggering a gift of the entirety of the Q-tip. Now that issue was addressed in the Kite case. Really terrible facts. It's unfortunate, but cases like Powell and Kite and so on, Klobaka, a lot of the law that we see is really bad facts, and it's uncertain how to apply it in situations that are not nearly egregious, not egregious at all. But be mindful of the 2519 issues if you do that. Here's just a point that I think is worth making. Many practitioners use wandry clauses and find that a wandry clause is a great safeguard to avoid or try to deflect a gift tax valuation challenge. In simple terms, instead of selling 50% of an LLC to a trust, I'm selling $10 million to the trust or gifting $10 million to the trust. And if I'm giving a dollar value or selling a dollar value of LLC interests, the remaining dollar value stays with me. So the only variable, depending on gift tax values, finally determined, and Jonathan mentioned the Nelson case earlier, which means you have to, you know, is confirmed you have to use the magical incantation of gift tax values finally determined. I haven't transferred the amount above that. I've only transferred the LLC interest up to the $10 million that I've decided to give. But there's a problem in 2021 using a wandry approach. And what is that problem? The problem is that if we will lose discounts, if we have a harsher, higher gift and estate tax rate, if we have restrictions on grantor trusts and so on, all the things that we've talked about, the downside of the wandry is, yes, it may help if it's successful in deflecting a gift tax on that audit, but then it's leaving in my estate where it may be much harder or impossible to get out of my estate the remaining membership interests. So one approach is to use like a Petter Christensen type approach, where if I own 100% of an LLC, I'm not going to get rid of 50%, I'm going to get rid of 100%. And I may sell X dollars, a defined value mechanism, to a grantor trust, and the remainder, if it's above that, never stayed with me, which is wandry. It doesn't revert to me. It doesn't stay with me, but rather it spills over into a separate receptacle, such as a charity, a donor advised fund, to a incomplete gift trust, and so on. But there's another approach too that you may use, and that is something that I've just dubbed a double wandry. So I have a gift or a sale of X dollars to a trust, and I simultaneously sign a sales contract effective the same date that sells any interest that remained in my name by virtue of the wandry clause to the same trust or perhaps even different trusts for gift tax value finally determined. And the point of that is you want to get all of the equity interests in some client situations out of their estate before these potential harsh tax changes. And I guess the take-home point I was just trying to communicate is that rethink using just a wandry clause, because it may not be ideal to have a large chunk of equity left in their estate if the wandry clause succeeds. So either use a spillover Christensen-Petter type case structure, or this double wandry that I've just described. Jonathan, any comments on that?
I think you've covered it very nicely, Marty.
Do you want to comment on intentionally defective deferred interest? And then I think we're going to wrap up because we're out of time.
Yeah, let me just mention, and this is going to take some time if you want to look at it. Under section 2701, if you wind up buying in a closely held business the preferred interest, whether it's stock or whether it's a preferred partnership interest, and basically younger members of your family wind up getting the growth interest, what traditionally would be, say, a common stock where you've gotten preferred stock, you are subject to an exception for qualified payment preferred. You wind up are going to be deemed to have made a gift of your preferred interest. So if I create, say, a partnership and I put in, say, $9 million and acquire $9 million worth of preferred, and my kids put in $1 million and they get all the common, I'm going to be deemed to have made a gift to them of the $9 million of preferred, even though I still have it. The 2701 says I've made a gift of the 9 million. But on the regs under 25.2701, I think it's -5 says, when I die, I get to reduce from my estate the value of the gift I made. So the preferred stock will come into my estate, and I will have retained benefits from it for the rest of my time. So it's not like I've given it away, but I'm going to get payments. That's a very good deal, especially for people who want to keep their hand in it. And yet, even though the preferred will come into my estate, and you can make it worth exactly 9 million by having a put right at 9 million, the disregarding of put rights is only for gift tax purposes. So when I die for estate tax purposes, my estate would have the right to put it back to the enterprise for 9 million. It's going to be in my estate at 9 million, and yet I have a $9 million offset. So I've been able to use my exemption, and yet I'm going to be able to benefit from the property, and yet I'm going to be able to not have a real increase in my estate. Now, the service, when it came out with certain rules, said that they may go ahead and put in some special rules where you try to do such things, but that has not yet come up, and it looks like this could be a very good way to go forward. And again, I doubt if that kind of change would be made retroactively. We just don't know. But this preferred stock or partnership freeze mechanism, where you obtain the preferred, have your descendants acquire the common, could be a very, very wonderful way to use your remaining exemption.
So just to wrap up, we've tried to highlight some of the specific nuances of planning that are a little unique or different in 2021 in light of the current political environment, the concerns about retroactivity, how you may want to modify the planning you're doing in light of potential changes that may change the traditional application of certain mechanisms. We've talked about, and Bob Keebler in particular, a whole range of interesting income tax planning ideas for some of the potential changes. And I think in his conversation, it was pretty clear that the rules and the planning concepts that we've used for so long may change significantly, and the income tax changes will have potentially a very significant impact, especially if there's a change in basis step up on the estate planning that we do. Jonathan, do you want to make any last minute comments before we close?
Well, I just think, Marty, that everybody needs to know that this is going to be, again, a very, very busy year between now and the end of the year. But I would suggest you advise your clients of the options now so you don't have a year-end crush. But I say that, but there will be a crush, I'm sure, before the end of the year, unless they've tried to do things retroactively. But talk to your clients now. Try to get them to consider doing something, but obviously it's always their decision.
I'd like to thank Jonathan Blattmacher. I'd like to thank Bob Keebler for joining me on this program, and I hope that it was practical and provided some useful ideas to each of you. Thank you for joining us.